everyone. A minute to go until the start of cash equity trading on Francine Lacqua in London with Tom McKenzie.
And here are your top stories. China's export engine runs out of steam in May, adding to evidence that global demand is weakening. European stocks open imminently. The SEC ramps up its crypto battle, taking aim at Coinbase a day after suing Binance. Coinbase CEO Brian Armstrong says he's proud to represent the industry in court. Plus, we are live in Versailles, France for the IEA Global Conference and in Berlin for the Super Return Conference with newsmakers from both events this hour.
Now let's take a look at the futures. Tom, we're about 20 seconds away from that market open. Of course, a lot of the focus is on some disappointing China data. That means that Bloomberg Economics is now expecting some kind of stimulus, including a possible interest rate cut. And then we look, of course, at traders looking out for more, not only government support there, but across the world, Tom.
Yeah, it's a question as to whether or not bad news is good news when it comes to the data out of China. Will the increasingly bleak data picture pressure officials in Beijing, as Bloomberg Economics expects, to go through with a cut come mid-June? Certainly there is a bit of speculation that's kind of come to the fore, and that is feeding into the Asian session. It's worth just briefly reflecting what happened in the US as we look at the Spanish IBEX, currently down 0.1%, the UK in a similar picture, down 11 points. What happened in the US is you ended in the green with a little bit of upside, but the broadening out of that rally, you're just a hair's away, of course, from the bull market for the S&P, but the moves into financials, the moves into Russell 2000 suggest that maybe that has further to run. The FTSE 100 now down 0.2%. Over in France, the CAC 40 off by 9 points, and Germany, the DAX, is flat. Let's switch it on and reflect on what's happening with the Turkish lira, but also the futures stateside, pointing flat after the modest gains of yesterday. Again, there is this tug and pull around the debate as to whether or not this is a bear market wrapped up, a bull market wrapped up in bear's clothing, or not, how much further that has to run. Brent currently down 0.8%. So the gains that came through on the back of that Saudi cut, they've all been wiped out. So the impact of the Saudis, the impact of OPEC Plus on this oil market in question. The Turkish lira falling to a fresh record against the US dollar, down more than 5%, close to 5.5%, as there's increased speculation that the government under Erdogan, after that win, is going to step back in terms of supporting the currency. Bitcoin, of course, in focus, given all the SEC action, 26,800, just down 0.4% for the largest cryptocurrency out there, 26,800, Fran.
Tom, let's also look at what the OECD is predicting. Global economic growth will slow to 2.7% in 2023. It's actually, it's interesting to look at all of the different breakdowns of actually what we heard from the OECD, because it gives us a good indication of, for example, France GDP, they're expecting it to grow 1.3% in 2024. So it's not as bad as expected in certain parts of the world, and the new economic outlook is a little bit backward looking, but again, the trend is towards a slow recovery, but a recovery nonetheless. Chinese exports fell for the first time in 3 months in May, adding to risks in the world's second largest economy as global demand weakens. Now let's look at the global market reaction with Bloomberg's Markets Today managing editor, Christine Aquino. Christine, thank you so much for joining us. We need to talk crypto, we need to talk China, we need to talk data in general, but there's a lot of currency moves. What are you watching out for?
Well, Francine, I mean, as you say, a lot of cross currents in the currency market. I mean, I'm particularly watching out for perhaps a resurgence of dollar strength that would add to the pain in the rest of the currencies across the world, because we're definitely seeing, again, that continued resilience in the U.S. economy that really supports this idea that while the Federal Reserve might hold in June, they may not move away from the idea of further rate hikes beyond that month. And, you know, we're already seeing kind of a bit of a pullback in various currencies. You mentioned the Turkish lira, of course, domestic political reasons contributing to that. But generally, there has been a bit of softness in just the currency complex apart from the dollar recently. And a lot of that owes to the fact that the U.S. labor market in particular just looks incredibly strong and resilient.
U.S. equities, the S&P, ended close to that 4,300 level. So again, within a hair of a bull market. And it seems to be always concerned about the lack of breadth in that rally. And yesterday, there was some evidence that it's starting to broaden out into financials, into the Russell 2000. Does this have further to run?
Well, I mean, there's definitely a lot of arguments for the longevity of that bull market, Tom. I mean, we're definitely seeing, as you mentioned, the more signs of it broadening out, which is definitely a good sign at this point in time. We're also seeing just kind of more positive outlooks when it comes to corporate profits, right? I mean, in the most recent earnings season, we have seen a lot of people, companies themselves, bracing for a potential downgrade in earnings outlooks. We haven't really seen that materialize. And I think, again, that just really is part and parcel of the state of the U.S. economy as a whole that is proving to be quite resilient. And we're seeing that definitely in the corporate space. And so these are definitely very supportive reasons for the bull market to continue. Naysayers will say, no, it's still too expensive at these levels. And, you know, it still has been quite concentrated in some of just the biggest stocks on the S&P 500. But really that broadening signs very encouraging for the state of this current bull market.
Christine, very quickly, when you look at what's going on with the SEC and crypto, I mean, they're getting slammed. Where does this end?
Well, Francine, I mean, I'm sure that it's definitely spooking a lot of investors, particularly, you know, your crypto tourists who kind of piled on at the start of the year and hoping to get to that 30K level in Bitcoin. We haven't really gotten there, of course, and we've seen a bit of a pullback since then. So at the very least, I think, you know, it will take some of the froth out of that market, given that the regulatory concerns continue to plague the cryptocurrency market here.
Thank you so much, Christina Aquino, there, Bloomberg Markets Today managing editor. Now, the U.S. Securities and Exchange Commission is suing Coinbase. It has accused the crypto exchange of breaking rules, including letting users trade tokens that were actually unregistered securities. The SEC chair, Gary Gensler, spoke to Bloomberg's David Weston about the actions against Coinbase and Binance.
This is actually a straightforward securities case, but it's in the context of crypto. And let me just say, crypto tokens, the investing public needs that same disclosure, a full, fair, and truthful disclosure, we say. And in the crypto space, it's largely built on a business model that's non-compliant with the securities laws. People are commingling all of the customer funds. It would be as if the New York Stock Exchange is also operating a hedge fund and trading against their customers, or add to it that they don't have proper controls to avoid manipulative trading on the platform by their sister. So here, Binance had a sister organization controlled by Mr. Zhao called Sigma Chain. So absolutely, it's straightforward. Protect the public through the securities law, build confidence and trust, but it's in the context of crypto.
You have said elsewhere that there are certain custody rules here that registered financial advisors have to pay attention to when it's something like Binance. Are you looking at some of those financial advisors for possible violations?
Look, I'm not going to get into any one investigation or case that we haven't yet brought, but I would say this to all of those investment advisors out there that may be interested in trading in crypto. Your client funds, under an existing 2009 rule, have to be proper qualified custodians, and that's not what you have on Binance. Make no mistake. In fact, as we alleged, your funds in custody at Binance, you don't even know really who's where it is. You know that Mr. Zhao ultimately is controlling it, but it may have actually moved it to a sister organization. There's another one that we allege, Merit Peak, that billions of dollars of funds were moving to.
The SEC chair, Gary Gensler, speaking to Bloomberg's David Weston. Also, in that interview with David, he spoke about the potential for that entire industry to collapse like, quote, a house of cards. Pretty strong opinions there and views coming through from the SEC chair as he pursues this action. Clearly concerned about commingling of some of these parts of the market. Crypto, by the way, looking at Bitcoin, currently trading at 26,843, down 0.3%. Coming up, we're going to bring you the latest on the massive dam breach in Ukraine. That's as towns and villages in the region face an environmental catastrophe. That is next. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
Is
story.
there the kind of upside?
Welcome back to the Open. We're 11 minutes into the European trading day this Wednesday. European stocks, the benchmark down close to 0.2% after the gains of yesterday. Futures in the US pointing to the losses on the S&P E-minis of 0.1%. Across your sectors, though, retail is leading the charge. That is one sector firmly in positive territory thanks to a beat coming through from Inditex. Retail as a sector gaining a little over 2%. But you do have losses coming through for chemicals, basic resources, healthcare, consumer and food and beverage. The currency that's in focus for us today is once again the Turkish lira, back to a fresh record low, below 23 to the US dollar, on speculation that the authorities, after Erdogan won that third presidential victory, will loosen their grip on the currency. A 12th straight day of losses for the Turkish currency. And you can see they're currently trading down close to 7% versus the US dollar on an intraday basis. A couple of individual stocks on the move for us. I touched on this in terms of Inditex, the beat coming through in terms of first quarter earnings, EBITDA of 1.5 billion, little under 1.5 billion versus the estimates of 1.35 billion. They've done a good job, it seems, in terms of focusing on larger stores and efficiencies, gaining 4.5%. So investors rewarding those results for Inditex, the owner, of course, of Zara. Danske Bank putting some of their historical woes around money laundering thundering behind them, gaining 4.3%, raising their profit targets and setting themselves return on equity of 13% in 2026 is their investor day today. They're also pledging dividends of around 7.2 billion by 2026 as well. Ericsson in focus for us as the FT reports that the EU is looking at a mandated ban on Huawei across the European Union for national security reasons. Just a third of countries currently have a ban in place, and so Ericsson, Nokia could get a bit of a lift on the back of that news. Fran.
Now, President Biden has vowed to continue assistance to Ukraine after an explosion at a major dam flooded villages and threatened supplies of drinking water and electricity. Ukraine's economy minister told Bloomberg that the attack should be considered an ecological weapon of mass destruction. She spoke to us in an exclusive interview.
What happened today, without any doubt, it might call and should be called the biggest man-made disaster. And the Russia, they've proven once again the whole world that they act like a terroristic state, and I think they used this disaster, and it seems to be like an ecological weapon of mass destruction.
Well, joining us now is Bloomberg senior reporter for international affairs. He's Mark Champion. So, Mark, clearly Ukraine accusing Russia there, who occupies the dam, of blowing it up, but intelligence agencies are still assessing who's responsible.
Yes, I mean, there's a huge amount that we don't know. It's interesting that the US and the UK are very staunch supporters of Ukraine. Neither of them have come out to say this was Russia. They're still looking at it, the kind of finger of suspicion points at Russia simply since they've been in control of the dam. Ukraine has been claiming for a long time that the Russians have been mining it, but the honest truth is we don't yet know.
What do we know then, Mark, about the impact on the agricultural sector? The importance of that, of course, being reminded of that just in the last few days with wheat prices skyrocketing. The impact on agriculture, the impact on people around the dam.
It's going to be really big. This is the agricultural south of Ukraine, already very scarred by the war, of course, and divided. The front line goes right along the Dnieper River there. So you have a lot of grain-producing land, the famous black earth of Ukraine, all the way on both sides of the river. But the real difficulty is that the water from the reservoir was provided the irrigation for that land. It goes far beyond the river, and therefore you had some movement in grain prices yesterday.
Okay, Mark Champion, thank you very much indeed on the latest in terms of the impacts of the destruction of that dam. Of course, the intelligence agencies, as Mark was saying, still trying to assess, at least those of the UK and the US, as to who was responsible, with, of course, a number of people pointing the finger at Russia. Coming up, we are off to Versailles, where the chairman of Schneider Electric joins us from the IEA's Global Conference. That interview is next. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, If it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open, everyone. 18 minutes into the European trading day. The focus firmly, of course, on some China data, what that means for world growth, what that also means for, of course, some kind of policy reinforcement to support the economy going forward. Now, let's also get to the Bloomberg First Word News. And the UK Prime Minister Rishi Sunak will seek closer economic ties with the US during his first visit to the White House since becoming leader. Now, the two-day trip is Sunak's most extensive interaction with President Biden, and it will see him meet congressional leaders and company executives. The two leaders are also due to discuss Russia's war in Ukraine, Chinese aggression, and the regulation of artificial intelligence. The U.S. Securities and Exchange Commission has widened its sweeping crackdown on crypto by suing Coinbase for allegedly running an illegal exchange. Now, regulators allege the biggest U.S. crypto exchange evaded rules by letting users trade numerous crypto tokens that are actually unregistered securities. Coinbase criticized the SEC's approach and says it has a demonstrated commitment to compliance. UBS says there will be a grace period of more than 2 years before Switzerland imposes higher capital requirements related to its takeover of Credit Suisse. An increase in capital triggered by the acquisition will be phased in from early 2026 based on an integration plan to be developed by UBS. U.S. Secretary of State Antony Blinken is said to be planning a visit to China in the coming weeks for talks with top officials, possibly including President Xi Jinping. Now, Blinken had planned to visit Beijing in February, but scrapped the trip after Washington identified what it said was a Chinese spy balloon crossing the U.S. The Confederation of British Industry has won the support of 93% of members who voted at an extraordinary meeting to decide its future. The CBI, the UK's biggest business group, asked members to support a reform program aimed at winning back trust following multiple allegations of sexual assault among staff. A loss of the vote could have led to the organization's imminent collapse. Boeing will delay deliveries of its 787 Dreamliner after uncovering defective parts. Now, the plane maker says it may affect about 90 already built jets and a few being assembled. Boeing and U.S. regulators have not decided if they need to take any action for jets currently in service. The company says it still expects to deliver about 70 to 80 Dreamliners this year. And that's your Bloomberg First Word News, Tom.
Okay, artificial intelligence, of course, has been central to the upside that we've seen for these equities. And it is important, of course, for Israel's economy, some describing it as the biggest opportunity. That is according to the nation's Minister for Economy and Industry, Nir Barkat. He spoke exclusively with Bloomberg's Romain Bostic.
Look into the future. Israel's now focused on a number of clusters where we are really good at. Naturally, you look at the classic high-tech, homeland security. Israel's huge and big on that. And there's a lot of overflow to civil applications and that are really smart in satellites, in space, and other things. Then you have the medical arena, where Israel's really powerful, lots of research and great innovative ideas. Agro-tech, food tech, desert tech. But the biggest opportunity Israel has right now is AI.
Okay.
For that, you need lots of brain power, lots of talent, and Israel's, thank God, with a lot of that talent. You would probably see Israel leading in many, many initiatives in artificial intelligence, leveraging artificial intelligence for health issues, homeland security, and others. There's no doubt in my mind. We're geared to look at the opportunities of AI.
Right.
I believe it could be a game changer, similar to what the internet did to the world.
You think it's going to be that big?
It possibly could be that big in terms of opportunities it opens up for tech-oriented countries. Israel today has about 10% of the labor force in tech, and we will grow. My goal is to get to 25% within 20 years from now, and to be a major player in the global market.
Where does that growth come from?
Well, naturally, it comes from global market. As I said, we have a tiny market.
For all the companies that you have there fighting for this piece of a pie, there are just as many companies in Europe, Asia, and obviously here in the U.S. also sort of looking for a piece of that pie as well.
Yeah, I know, but each one of us we have a competitive advantage in technology. Technology in many, many areas, as I said before. Everything is tech, high tech, agro-tech, desert tech. So you will see Israeli companies excel in AI. You will see us really doing well in the global marketplace. Lots of global relationships. Personally, I believe that you will see us in next year promote many of these innovative ideas, and we're promoting that internally and helping our entrepreneurs go global.
Well, that was Israel's Minister for Economy and Industry, Nia Barkat, speaking to Bloomberg's Romain Bostic. Now, the conversation's shifting when it comes to private markets. As big firms get even bigger, a fragile economic backdrop is threatening the survival of their smallest counterparts. The dynamic will be a theme, of course, at SuperReturn's three-day conference, which kicks off in Berlin today. And our very own Danny Berger joins us from the event with a great guest. Danny, over to you.
Hi, Francine. Thank you so much. That's right. I am here with Carlyle. I'm here with Marco De Benedetti. He's, of course, partner and co-head of Carlyle Europe Private Equity. Marco, so great to talk with you today.
Thank you for having me.
Look, last time we were talking, I remember very specifically you said it's dangerous to make predictions, but I mean, you like to live a little dangerously, Marco. Look, you called the peak, you called the slowdown. When does the revival come?
I don't know. From a macro point of view, I think it's still quite uncertain, both in North America and Europe. The big reopening of China really is another dimension. So I think it's going to be a cautious second half of the year from a macro point of view. That doesn't necessarily mean it's a bad time for our business. Usually the best vintages is usually during this period. So we're actually quite optimistic from an investment point of view, even though I think the macro is still going to be a few quarters away before we see a bounce back.
Does the macro, a few quarters away from bounce back, mean that there's things that you used to invest in that you wouldn't now in this environment?
Not really. I mean, our type of investment is what I call very micro-based. So it's really around the individual asset we identify, what we can do with that asset, how we can develop it, how we can strengthen the management teams, which I think it's a little bit less cycle dependent. And this is really what we want to do, is to have a consistent performance through cycles and not to be overly cycle dependent.
How hard is it, though, to originate deals, to do them, to get the financing? What does that look like in this environment versus, let's say, the peak in 2021?
You know, clearly there's been a significant slowdown. We saw it on the volume of transactions. Usually buyers tend to adapt to the new pricing environment much faster than sellers. And so what usually happens, you have a bid-ask spread which goes through the roof, and guess what? No volumes. The trough was probably Q4 of last year. We're seeing it coming back. The financing market is getting back to a more functional level. I think buyers are probably a bit less catastrophic. If you look in Europe, I think the performance of the European economy was a little better than what most people anticipated. So I think the resilience of the economy gave some comfort to buyers, and at the same time, sellers said, well, you know, the old days are gone for good. And so we're seeing that bid-ask spread getting a little bit more in sync, and so we're seeing a pipeline building up quite nicely. I do expect that, you know, Q2, Q3, Q4, we will see it. Most likely not to the level of 2021, but that was the outlier year. Okay. But if you take it on a more long-term average, I think, and deal flow is not the problem. So, you know, for people like us, we have the possibility and we are able to source enough opportunity. It's really about the selection. It's about finding the right one. But the deal flow is not the problem. The financing market is starting to come back. So I think the conditions are all there for us to continue.
Some signs of life then. In terms of finding in the economic difficulty opportunities, sports is obviously a big one. I know you're a football fan yourself. Serie A, talk to me about how those talks are going. Are you still bidding? Does it look like they might sell some of their media rights?
It's a process that has been going on for a while. That has been a theme in Europe, which, you know, it happened in Spain, it happened in France, there were talks in Germany. So all of the leagues see that as an interesting way to fund their development, and Italy is following the same path. It's a process that has been going on for a couple of years now. Now finally an advisor has been appointed for that process, so that should start, and we'll see. But that is certainly something which is interesting. I think football and sports in general have proven to be a very valuable property that has further potential to exploit. Think not only the TV right, which is the bulk, but all of the new medians and everything else. We believe it's potentially an interesting space.
What about not just the media rights, but the teams themselves? I know Carlo's name had been floated as a minority stake in Man United. Is that?
No, not really. We were looking at, you know, possibly some financing. I personally am a little skeptical because I try to invest in businesses where, as much as possible, we are in control of the outcome and less dependent on external factors. And in sports, the relationship between the success from a sports point of view, and therefore your ranking and your winning, and the economics, I mean, that's not such a straightforward equation. So I think it's a little tricky for private investors, and I think we'll stay away from those.
I'm going to take you around the world. All right, we've talked about European sports. I want to talk to you about China because you have a deep expertise, not just the consumer, but luxury goods too. Obviously, LVMH has skyrocketed. It's biggest company in Europe. That luxury story really hinged on China. From the companies you look at, is the Chinese consumer strength here to stay? Because some of that macro data has disappointed.
Well, I mean, specifically on the luxury space, you have to remember that 80% of the luxury consumers are not in Europe, while most of the brands are in Europe. So for those European brands to go where the customers are is fundamental. It's North America, it's the Middle East, and obviously it's Asia. China alone represents between 30 and 35% of the luxury spend. So for any luxury company, China is an important market and an essential market. That has gone through cycles with the COVID lockdown last year. We've seen since the very end of last year, the first quarter was very strong. The comeback of China was very important. We'll have to see how it continues, but I think for any of those companies, you just can't forget China. It's such, in absolute terms, such a relevant part of the luxury market that is fundamental. And everybody was hoping for the comeback. It was very strong. And so I think it's encouraging.
All right. Well, we'll have to leave it on that cliffhanger. Marco, really great to speak with you this morning. That's Marco De Benedetti of Carlyle. And with that, I'll bring it back to you, Tom.
Excellent stuff. Bloomberg's Danny Berger and Marco De Benedetti, the co-head of Europe Private Equity at Carlyle Group. Thank you very much indeed. And of course, Carlo, talking there about the importance of the Chinese market, we had a reminder that if we are close to a tipping point for the authorities to act more assertively and aggressively, maybe we got it with the lackluster export numbers coming in below the forecasts. Again, Bloomberg Economics, they think there will be a cut to benchmark rates potentially as early as mid-June. And that's why you saw some stocks in Hong Kong rally on the back of that. Here in Europe, you're seeing just very modest losses, about 0.1%. You did see some gains yesterday, really lacking a bit of direction. There's one individual corporate story that jumps out, and that's Inditex. I'll give you a little bit more details when we break down the sector impulse, but that is lifting the IBEX. The DAX, though, down 20 points, down 0.1%. The FTSE 100, we had some details coming through from Halifax, the first annual drop in house prices for a number of years coming through for the UK. The FTSE 100 down about 0.1%. The sectors then, let's switch it up because it is what is happening in the retail space that is taking some of the spotlight, at least for now. Retail as a sector gaining 2%. It is all about Inditex. Jefferies describing the results that came through from the first quarter as really impressive and saying there's the now, and I'm quoting, the tantalizing prospect of margins for Inditex getting back to pre-COVID levels. That from Jefferies analysts. It was a beat. And of course, they focused on larger stores and some of those efficiencies, and that's really paying off for Inditex. Bottom of the list, you've got chemicals, auto parts, and healthcare. Energy, a reminder that the upside that we got coming through from the likes of Brent and WTI on the back of that Saudi cut announced is going to come through in July. Well, that has faded so much for the Saudi pushback on those shorts. Fran.
Now, Tom, the IEA's 8th global conference is taking place in Versailles, France today. Over 30 ministers, 40 chief executives, and hundreds of senior leaders are joining the event, which is centered around the theme of energy efficiency. Well, Bloomberg's Caroline Conan joins us now from the conference with a guest. Caroline.
Francine, yes, and I'm joined by the co-host of this global IEA conferences, Jean-Pascal Tricoire, the chairman of Schneider Electric. Thank you for being with us today from this IEA conference. So obviously, you make electric devices and technology. How much do you think demand growth from electrification will actually be counteracted by the energy efficiency on the demand side?
Well, look, if you take the big picture, what we need to do in the next coming years is to drastically revert the trend of carbon emissions. And it's not an evolution, it's a revolution. And it's a combination of three things. We still have to decarbonize the fossil fuel that will be with us for many years to come still. Then we have to electrify the usages, because when you electrify, you eliminate carbon. But that should be coupled with a big growth of decarbonized energy, namely renewable on nuclear. On the third point is energy efficiency. Energy efficiency makes 50% of the reduction of carbon emissions, so it's absolutely critical. When we speak about energy, normally people always speak about supply. They love to speak about oil, gas, nuclear, renewable, and so on. But the forgotten child of the energy transition is energy efficiency, while for every company and every country, this is a priority. And the good news is that technologies are changing. The problem is that it's going too slow. Today, we should be multiplying by 10 the deployment of energy efficiency techniques. And that's possible now because we are moving from traditional techniques, which were more passive on the walls, on the roofs, on the windows, to digital technologies, smart homes, smart buildings, smart grid, smart metering, which can be deployed with 1/5 to 1/10 of the cost on the time. But this is a challenge, going from technologies of the past to technologies of the future, or complementing what we do with existing technologies with new technologies.
Is the current tightening of financing conditions actually not helping? Could this delay all these efforts on the demand side?
Look, energy efficiency is one of the very few investments where actually you save costs afterwards. You make a one-shot investment into green capex to get rid of recurrent brown capex. The price of energy has risen so much, on the risk on energy availability has risen so much in the past 2 years, that the return on investment has been divided by 2 in many places. And very often it's below 3 years, so it's an excellent return. And now, on the financing of that one-shot investment that brings in 20 years of savings, we have to engineer better financing solutions, and this is what government are working on. 70 countries today have put into place incentives to energy efficiency, so that thing is really changing very fast.
And what are the challenges for the grid, given the increasing amount of intermittent solar and wind power? What are the current challenges?
Look, it's an evolution and its opportunities. The first point is, another big part of the evolution is, first, when you electrify your usages, without knowing it, you are becoming more efficient. A heat pump is 3 to 4 times more efficient than a gas boiler or a fuel boiler. An electric car is far more efficient than an ICE, than a traditional car, because you go straight from clean electrons to the wheels, right? It's 90% efficient. Your present car, if it is a fossil fuel car, is only 40% efficient. So when you do that, you are already getting much more efficient. The second thing is that we can all become producers of clean energy. On your roof, close to your building, we do more and more microgrids. We equip your houses with that. So when you do that, you actually alleviate the pressure on the grid, because you do a lot of things locally. You consume your own energy. on the grid, and we are working with many utilities at Schneider. We are one of the leaders in this field. Is becoming smart and able to help us to better share energy. That means buying energy or storing energy when it's green and cheap in your electric car battery, for instance, or at the same time selling energy when we have a surplus of energy and the grid needs it. So that world is very different from what, it's the same revolution as the internet 30 years ago, right?
But I mean, of course, now we're also seeing a lot of cyber attacks and physical attacks on energy infrastructure. So what kind of technology are you developing in order to prevent these attacks?
Believe me, a company like Schneider is investing tons on that, as well as the whole industry, as well as all the government agencies. We are working like this together to really make sure that the defenses on those cyber attacks are becoming higher and higher. It's often safer to be connected and to monitor what's happening than to try to establish a moat around your installations. And this is what this hyper-connected grid, going from whatever produces energy to whatever consumes energy, is actually safer than the system that we have today.
Schneider Electric is investing tons to protect all the energy infrastructure from cyber attacks. This is obviously one of the topics that will be discussed here today at the IEA's 8th Global Conference on Energy Efficiency from Versailles. Fran, Tom?
Okay, really interesting conversation. Thank you, Bloomberg's Caroline Connor, with the chairman of Schneider Electric. Thank you. Coming up, we're going to speak to Sumant Sinha, the chairman of Renew Power. It is one of the largest renewable energy companies in the world. That conversation coming up next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to the Open, everyone. 41 minutes into the European trading day. A bit of pressure across the board. You can see U.S. futures are down. European shares definitely down. I think there's a bigger than expected drop in Chinese exports, basically stoking further concerns about the strength of global demand. And they're not focusing on the positives, which could be more policy supports. Now, India presents a massive opportunity for clean energy developers as it aims to almost triple non-fossil fuel power capacity by 2030. Renew Energy is one of India's leading solar and wind companies, alongside the likes of Adani Green. Now, we're pleased to be joined by Sudhant Sinha, the Chairman and Chief Executive Officer of Renew Energy. Thank you so much and welcome to Bloomberg. When you look at the market in India for renewables, how do you describe it? There are many opportunities, but there are also challenges, including import taxes.
Look, I think if you look at the Indian power market in general, it's the third largest market in the world, and it's growing at about 6% a year. So it's actually a very large market, growing very rapidly. And within that, there is a massive transition that is happening towards clean energy. And I think that's really being driven by the government under Prime Minister Modi. And you know, the government has a vision to get up to 500 gigawatts of installed renewable capacity by 2030, which will essentially mean that almost a third of India's entire generation of power will come from the clean energy sector. And that requires a fundamental overhaul of the entire power sector in the country. And I think it's being driven by some fairly, I would say, enlightened policies on the part of the government. And that's making life for companies like us a lot easier. It's opening up a lot of market opportunities for us as well. And you know, we need to almost have a 3 to 4x increase of capacity.
What kind of opportunities?
So basically, obviously, we have to add a lot more wind and solar capacities. We've been adding about 15 to 20 gigawatts of wind and solar capacities in India every year. But the government has now come out of the plan to increase that by almost 3 times to about 50 gigawatts a year if we have to meet the 500 gigawatt target by 2030. And so therefore, obviously, that is throwing up massive opportunities for companies like us. It's basically an investment opportunity of almost $500 billion over the next 7 to 8 years.
So, what are the challenges, though? I mean, Francine talked about some of the import tax challenges, particularly around solar modules. Is that something? Are you working with the government to work through some of those issues? Is that a headwind for you? How do you take advantage of pushing through on this demand?
Yeah, look, that's a great question. I think what happened is that a couple of years ago, the Indian government took a strategic decision that we wanted to create a domestic manufacturing industry rather than being reliant on imports from other parts of the world.
Is this a concern about China?
From China. That's right. And a strategic call, I would say, on the part of the government. And they basically told us that they wanted to actually set up domestic manufacturing capacities. And so we as a company, for example, have been putting up a solar plant. We're getting our first solar module plant commissioning by the middle of this year. It's a 4 gigawatt module plant. And so companies like us are now setting up domestic capacities. And so over a period of time, you'll see the entire solar value chain getting set up in India, which is really what the government's intent is, to have and foster self-reliance within the country. But what that will also mean is that we can now start shipping out to other countries from India as well, once the whole supply chain gets set up, and essentially position India as the +1 to China from a solar supply standpoint. And I think the world really requires that diversification as well. So India really, with the domestic policies that we have, is really pushing in that direction. So again, I think a fairly important strategy. Now, what that means is in the short run, there are some disruptions as new capacity comes online and we start squeezing imports and so on. But I think that's just very temporary in nature. I think eventually it is going to lead to a domestic industry and self-reliance.
So what kind of market share in terms of energy consumption in India is currently green, and how rapidly will that increase, and what does it mean for your company?
Yeah, look, good question. So today, wind and solar account for about 12% of India's total power generation. But if you add hydro and nuclear to that, which are also in some ways clean sources, that number goes to about 25%. By 2030, wind and solar alone will be about a third. And if you add nuclear and hydro, that will go up to almost 50%. So by 2030, almost 50% of India's power supply will actually not be coming from fossil fuels, which is actually going to be a fairly significant change. And I think very few countries in the world by that time will have such a large percentage share of non-fossil fuel-based energy generation.
So, Matt, we know that you're looking to expand your footprint overseas. There's been reporting around the project in Egypt, for example. You've been doing feasibility studies, potentially worth about $8 billion. Get us up to speed on how that is progressing.
Yeah, sure. So look, I think what's happening is that now in the clean energy transition, we're now looking at opportunities beyond just the electricity sector or the power sector. And there are obviously, as we all know, the development of the whole green hydrogen and green ammonia ecosystem that is now beginning to happen. Mandates are coming in. You know, in the European Union, there's a very big push towards generating almost 20 million tons of green hydrogen every year. In India, the target is 5 million tons by 2030 as well. So every country now is setting very ambitious targets for decarbonizing the non-electricity parts of the energy value chain. And that is throwing up a lot of opportunities for companies like ours. Now, this new business is not going to be confined within borders. It is going to be a globally traded commodity.
Do you have customers in Egypt for that $8 billion hydrogen?
No. So the point is, right now, we're looking at opportunities to manufacture in certain countries, including India, by the way. Egypt is one of the countries we're looking at in the Middle East, but equally we are looking at other geographies as well. But customers are going to be sitting in Europe, they're going to be sitting in India, they'll be in the Far East and so on. So the idea is to actually export from these countries.
But that means a huge infrastructure, right? So I don't know how you invest in that and how quickly that could come online.
Yeah, so look, I think that in green hydrogen, you're absolutely right, it's going to require, each project will require several $1 billion of investments. These are very large-scale investments. It's not something that any one company can make on its own. So you'll see a lot more collaboration happening between off-takers, between project developers, between financial investors. So you'll see very different kinds of project structures coming into place for setting up green hydrogen projects. So you'll see a lot more partnership, collaboration with different companies providing different skill sets and capital coming in to do some of these projects and basically sharing risk, because that's what it's also
very briefly, your largest shareholder, the Canada Pension Plan Investment Board, are they taking you private?
I obviously don't know because I'm not sitting in their shoes, so I really can't answer that question.
Okay, really appreciate you coming on and fielding the questions. Sumant Sinha, the Chairman and CEO at Renew Energy. Let's get the Bloomberg First Word News now. UBS says there will be a grace period of more than 2 years before Switzerland imposes higher capital requirements related to its takeover of Credit Suisse. An increase in capital triggered by the acquisition will be phased in from early 2026. That's based on an integration plan to develop by UBS. And UK Prime Minister Rishi Sunak will seek closer economic ties with the US during his first visit to the White House since becoming leader. The two-day trip, Sunak's most extensive interaction with President Biden, will see him meet congressional leaders and company executives. The two leaders are also due to discuss Russia's war in Ukraine, Chinese aggression, and the regulation of AI. Ukraine is rushing to evacuate people from flooded areas downstream from the damaged Kakova Dam. This as Kyiv attempts to assess the humanitarian, economic and ecological damage from the widespread flooding. Up to 18 million cubic meters of water poured through a massive breach in the dam, swamping communities along the Dnipro River. And former Diageo CEO Ivan Menezes has died after a brief illness. He was 63. He'd been hospitalized and was receiving treatment for medical conditions, including a stomach ulcer. Menezes joined Diageo at its creation in 1997 and transformed it into the world's biggest premium drinks company during 10 years at the top of the business. He is succeeded as chief executive by Deborah Crew, currently the company's interim CEO.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Welcome back to the Open, everyone. 52 minutes into the European trading day. We're now seeing a bit of a reversal, down 0.2% for a lot of these stocks. Again, a lot of investors are worried about what the data out of China means for the strength of global demand. So we're seeing a bit of pressure, for example, on commodities. Now, the PGA Tour and Saudi-backed Live Golf have agreed to a shock merger. It ends a 2-year battle that saw the upstarts splash millions of dollars to lure some of the biggest players away from the traditional PGA events.
Obviously, it's been a very dynamic and complex couple of years. And for players, I'm not surprised that, this is an awful lot to ask them to digest. And this is a significant change for us, in the direction that we were going down. But as I'm trying to explain, and I will continue to explain as we go forward, this ultimately is a decision that I think is in the best interest of all of the members of the PGA Tour.
We'll get more now with our Saudi Bureau Chief, Matthew Martin, in Riyadh. Matthew, when the news broke, a lot of people had to take a double take and reread the story twice. After competing so aggressively, after saying this would never happen, why are Live and PGA suddenly changing course so dramatically?
Well, as you say, it had been a very, very acrimonious relationship between Liv and the PGA. I mean, they will say that they're doing this all for the love of golf and to promote the sport. But, I think when you dig in behind the scenes into what's been going, the legal battles between the two have been increasingly dirty. It had started to drag in the families of victims of 9/11. There was a lot of mudslinging going backwards and forwards. The head of the Sovereign Wealth Fund, Yasser Al-Rumayyan, was potentially going to be subpoenaed as part of this process. So this merger now enables both sides to draw a line under all of that and move on and stop spending all this money on legal fees, stop fighting out in public so vocally, and try and unite. And instead, it looks like they're going to be focusing more on golfing in future.
So, Matt, who is now in charge of global golf? Was this the PGA essentially just buckling to an avalanche of Saudi money?
Well, if you look at the statements that have come through, initially what's going to happen is that the PGA is going to continue to hold the majority of the economic rights within the merged entity, which still doesn't have a name. But as you say, if you look longer term, the PIF chairman is going to be the chairman of this new Gulf Co, whatever it ends up being called. And the PIF, the Saudi Sovereign Wealth Fund, is also going to have first right of refusal in any new investments that happen as the sport grows and develops. So whatever investment plans come up in the future is going to continue to be backed majority, we think, by Saudi money. So we're going to see the Saudis increasingly taking on a much more prominent role in leading this new entity, I think, as time goes on, and putting them at the top of the golf's most important global body.
Fascinating. Matthew Martin in Riyadh, our bureau chief there More to come, no doubt, on this story. Thank you for the latest. Across these markets, before we take you to the end of the hour, you're seeing losses of about 0.1% across European indexes. The IBEX, though, remains in positive territory, lifted by the optimism around Inditex with its earnings coming through. Jeffrey's pointing to the potential of getting back to pre-COVID margins for that company, gaining 0.4%, the IBEX. Futures in the US currently down 0.1% on the S&P E-minis. That is it for the European market open. Surveillance early edition is up next. This is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
This is Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. China's export engine runs out of steam in May, adding to evidence that global demand is weakening. European stocks are lower. The SEC ramps up its crypto battle, taking aim at Coinbase a day after suing Binance, while Coinbase chief executive Brian Armstrong says he's proud to represent the industry in court. And we're live at the IEA's Global Summit in Versailles with Executive Director Fatih Birol. Plus, we go to Berlin for the Super Return Conference, the co-president of General Atlantic. Now, first thing is first, so let's check on the markets. European shares edging lower as bigger than expected drop in Chinese exports, really stoking further concerns about the strength of global demand. Now, we have Bloomberg Economics with the new projection now expecting the Chinese policymakers to support the economy. They're also talking about a possible rate cut in the coming month. A rotation into financial shares on Tuesday really also suggesting in the U.S. that the breadth of the S&P's recent rally might extend beyond technology pretty soon. So back to our top story, and Chinese exports fell for the first time in 3 months. In May, the weaker data adds to risks that the world's second largest economy, well, is going to consume less commodities and everything else. Joining us now is Karen Ward, JP Morgan Asset Management's Chief Market Strategist for EMEA. Karen, thanks so much for joining us. I have a million questions on inflation, of course, deglobalization, Sunak in Washington. But China, what do you do with this China data? So you could either take it as a positive because it kind of forces policymakers to do more, or it puts a dampener on global demand.
Yeah, absolutely. I mean, in the spirit of investors always wanting Goldilocks, the perfect, not too hot, not too cold, I think the fear was that China was going to come out of its COVID restrictions and actually add too much heat to the global economy. Now, clearly that's not happening, but maybe we're now edging to the porridge being a little bit too cold. The questions, I think, are how do they stimulate now? Because, of course, traditionally, the stimulus has been very focused on the property market, on infrastructure, and that looks like a route they wouldn't want to take again, given some of the concerns still in those segments. So I think for us as investors, thinking about what routes might they take now, I think it would very much be focused on the consumer, making sure that the consumer is their driving engine, which has been a path they've been on for some time. So I suspect we'll see stimulus. It will be very different to the past.
I think Bloomberg Economics is now expecting a rate cut. I mean, that'd be a bit of a bulldozer move. What does that mean for the rest of the world?
Yeah, absolutely. I mean, again, I think we're not going to see the scale, the magnitude of the stimulus that's going to take China back into the too hot, having huge implications. It will be providing a floor, making sure that that recovery is gathering steam. They are coming out in a different situation to us post the West in that they actually, because their stimulus wasn't big in the pandemic, they have some unemployment issues. They don't have that scale of pent-up savings that we did. So I think it will be more about making sure that things are just right rather than injecting vast amounts of stimulus.
Karen, I know also you argue basically in some of your top market insights with the team that the central bank put may have been replaced with the fiscal policy put. How do you play that?
Yeah, absolutely. I mean, we've just released a big report. Just now the dust has settled on the post-COVID world. What are we learning? So we're looking at all the changes in the supply side and also on the demand side. And one of the key points is that fiscal policy, which was really dormant post the financial crisis. We came out of the financial crisis with governments very worried about the level of debt. And whilst the central banks had their foot on the accelerator, fiscal policy was really on the brake, and in Europe, hard on the brake. So that's just changed. I mean, governments essentially have got a taste for spending. They have a new mindset about the role they should play in the economy. They've got stuff to do. There's energy transition, there's defense. So I think for us as investors, it's really noting that they have their foot on the accelerator now. So that has implications for the central banks. So maybe we can sustain higher interest rates because they aren't compensating for that drag from fiscal policy. And also just that if we do encounter periods of volatility, we're probably once again going to see governments being the primary policy tool to provide that support. So I think there are interest rate implications, and also as they're intervening in the economy, directing activity, we as investors need to think about where are they pushing, because we want to be ahead of that.
But Karen, overall, I feel like the market is a little bit schizophrenic, right? It's like a week it's very positive, the other week, and I'm not quite sure how it stabilizes. So if it needs an impetus, or at the moment they're grappling at so many news stories, there are so many shocks or non-shocks across the world.
Yeah, absolutely, and I think you're right. And again, probably coming back to my Goldilocks and porridge analogy, as we go back to October, and the fear in the market was very much, gosh, we're in the 1970s. We're going to need a deep recession to get rid of inflation. Then that narrative swung a little bit too much, I would argue, early in the year, back towards the Goldilocks. Oh, it turns out inflation's going to disappear all of its own accord. We don't even need that recession anymore. The central banks can therefore focus on growth. They can cut interest rates, support the economy and earnings. And both the bond market and the equity market, I felt, had just got a little carried away. It was a little too good to be true. I think we're now just seeing a reassessment of quite how resilient growth is going to be, but also the key indicator for us is still going to be inflation. If those core numbers are sticky, then the central banks are going to be a little bit more hamstrung about quite how much they can focus on growth.
I mean, regionally, do you still focus on the U.S. as more stability or not necessarily?
Coming back to the fiscal story, I mean, I do think that the change in Europe post-pandemic, post-Russia, is really significant. And therefore, I think certainly relative to valuations, I think we're more optimistic about Europe as an asset class than we were, for the prior decade. And I also think one of the things I'm a little nervous about is that the rates market got a little too carried away about the central banks being able to quickly, preemptively cut rates. And therefore, as we see those rates markets, which clearly they're already taking out some of those cuts, I think that story will continue. That, to me, puts some of those growth, those mega cap tech valuations a little at risk. And that, again, speaks to perhaps less weight on the US and a little bit more diversification elsewhere.
Karen, you also understand, of course, the UK market more than most. So Rishi Sunak for 2 days in Washington. What does he need out of the US that the US would give them that would be beneficial for this economy and for UK markets?
Well, ultimately, the post-Brexit, US-UK relationship, which was always, the hope would be that would be our new focus, really. And that's been slow in forthcoming, so any ground that can be made, I think for the economy, that's a pretty significant, even some token gestures towards where we're going on that trading relationship, I think would be majorly beneficial.
Karen, thank you so much, as always, for joining us. Karen Ward, their Chief Market Strategist, EMEA at JP Morgan Asset Management. We're just getting a little bit of breaking news out of China. So China, this is the end of May foreign exchange reserves. So it is a little bit backward looking. It's definitely what we saw, until the end of May. So it doesn't really take into account some of the wobbles that we saw in the last couple of days. But reserves are at $3.1 trillion. Pretty much as expected, actually. We were expecting 3.18, we got 3.17, but who's splitting hairs? Pretty much as expected, those foreign exchange reserves. I think we'll get a breakdown of exactly what that means and what they've been buying and selling. That would be interesting to see whether there's an anti-dollar play. Now, coming up, we're joined by James Reid, the chairman of the Chief Executive, one of the UK's largest employment platforms, to discuss the state of England's job market. It's not great news for graduates. We'll dig a little deeper into that. This is Bloomberg. So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, graduates are preparing to leave Britain's universities, and they're facing the toughest job markets in years. Now, there are few spots available, and wages for those posts are not keeping up with the jump in the cost of living. Bloomberg is producing a monthly report on the state of the jobs market in England using data from Reed Recruitment. So we're delighted today to be joined by James Reed, the Chairman and Chief Executive Officer of Reed Recruitment. James, thank you so much, first of all, for the partnership, because we get some great stories looking at your very detailed analysis that shows us who's looking for jobs, how much they get paid, and also in what parts of the UK. What do you find most surprising about what's happening to jobs that graduates need right now?
Well, it is surprising given that there's such a shortage of skills and such a shortage of workers that graduate jobs have actually reduced. And if you look at the data, which your colleagues have sort of forensically analysed, I mean, this goes back to 2018. So the graduate job has been in decline for 5 years now, and it seems like it's going out of fashion in some sense. So the people who are perhaps expecting or looking for a role where you get a training scheme and 3 years and you're classified as a graduate trainee, those are becoming more and more scarce. And I think that surprised a lot of people. And I think it's troubling some people.
I mean, it's troubling, actually, because if you're a young graduate, I mean, this is a workforce of tomorrow, but is it because COVID has changed graduates, and so they're less used to the workplace, and so chief executives think it's more of a burden? Or is it just because it's more difficult for chief executives or companies to train them?
I think there are a number of things happening. The graduates themselves have obviously been affected by the pandemic. They've missed out on opportunities to get work experience, to do internships, to get exposure to the workplace before they graduate. And now, of course, with remote working, it's harder for companies necessarily to onboard and train people if a large part of the workforce is simply working out of their homes. And so I think companies have that in mind, and they're perhaps looking for people who've got a bit more experience, who can hit the ground running. But that is a short-term approach, because in the long run, bringing people on in the business is a good strategy.
Yeah, and again, we have a lot of vacancies, right? I think that there's about 1 million vacancies or something of the sort out there in the UK economy. So who does that get filled by?
That's right. Well, I think a lot of graduates, if I was advising graduates, I'd say go for entry-level positions. Don't just look for graduate positions, because there are a lot of opportunities that are open to people at the moment, and some of them very well paid, and some of them in sectors that would have historically recruited graduates. Another observation is a lot of employers are very, very focused on inclusion and belonging there, EDI, equity, diversity and inclusion initiatives, and that has meant they've downplayed graduate schemes because they've been seen as somewhat exclusive and perhaps favouring certain groups, and they want to include everyone, so they're just putting everything through entry-level jobs, and in many ways that's welcome.
Okay, so maybe some of the graduate jobs are moving into entry level. Does it make a difference if you're looking for a job as a graduate in London versus Manchester or Birmingham?
Well, one of the interesting sort of nuggets of information that come out of the data is London is not such a magnet for these jobs as it used to be. It used to be almost 40% of graduate jobs are concentrated in London. It's now closer to 30%. So that's a significant change. And we're seeing more graduate jobs appearing in places like Reading, Birmingham, Manchester. So it's more spread. And I think the way people are working now enables people to live in different parts of the country and perhaps come into London, occasionally rather than every day. Because London's an expensive place for young people to live, and many are put off by that.
So I was going to say, why the change? Is it also because of the cost of living crisis, so that employers also have to pay their graduates more?
Yeah, I think it's driven by employers and graduates, really. People are looking at their options and thinking, well, if I can employ these trainees in another part of the country, that's better for my business. And also from the graduate point of view, if I don't have to pay large sums of money to commute or to find a place to rent, that's also helpful, because a very significant finding is that the wages have been squeezed. The real wages for graduate jobs have been squeezed, and they're lower than they were before. So there's a lot of pressure on young people coming into the workforce.
But James, so it's lower than before because that money, at the same time, we're seeing an increase, right, in salaries for I guess, older workers.
Yeah, I mean, many sectors are seeing increases. What we have observed, which is really interesting, is in-person premiums emerge. So people who have to attend the workplace 5 days a week, those jobs are commanding increases of north of 10%. So an in-person premium is being paid by employers for people to attend, which is interesting. But the graduate jobs overall, they haven't seen the same level of increase. And some of the sectors that attract graduates, like my own recruitment, haven't got as many jobs as they did a year ago when there was this jobs boom going on.
So I was going to ask you, actually, in terms of industries or sectors, which ones are the ones where they're looking for graduates?
Well, the fastest growing sectors are education and banking, interestingly. That's where we've seen the fastest growth in jobs. But the sectors like sales and recruitment have also recruited a lot of graduates traditionally. And I think graduates like those roles because they can learn a lot. I think it's good for young people to do sales at some point because all business involves sales. They can learn a lot. And actually, because there's a commission structure in many of those jobs, they can also earn a lot. So they're good jobs for entry level.
James, if you're a graduate and actually you have a higher percentage, if you have a higher chance of getting employed in Reading, does it mean that the levelling up agenda of the government is working?
Well, that's a big question. I don't know whether it's working, but there are some signs that it's happening, whether it's the government driving it or the economy or the labour market. There are signs that places like Reading, Bristol, Swindon have got more of these types of jobs. London has fewer. So I think if the economy is more evenly spread, that's a good thing. But I would say there's quite a way to go.
But is it in small numbers, or are you seeing a really significant move of some of these jobs elsewhere, away from London?
Well, we've seen Manchester. Manchester emerge as a very important centre and a very dynamic economy. An earlier jobs report that we did with Bloomberg showed that that was the fastest growing place for new jobs. So we are seeing that, but then you go down the road to Birkenhead and it's still depressed and earnings are perhaps 30% lower for people working there. So it's a pretty mixed picture.
All right, James, thank you so much. James Reed, the Chairman and Chief Executive Officer of Reed Recruitment. And then we'll also have an event a little bit later today with more on this index. Coming up, we'll bring you the latest on the massive dam breach in Ukraine as towns and villages in the region actually face an environmental catastrophe. That's coming up next, and this is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News, and we start with the UK Prime Minister Rishi Sunak seeking closer economic ties with the US during his first visit to the White House since becoming leader. Now, the two-day trip, Sunak's most extensive interaction with President Biden, will see him meet congressional leaders and company executives. The two leaders are also due to discuss Russia's war in Ukraine, Chinese aggression, and the regulation of artificial intelligence. U.S. Secretary of State Antony Blinken is said to be planning a visit to China in the coming weeks for talks with top officials, possibly including President Xi Jinping. Well, Blinken had planned to visit Beijing in February, but scrapped the trip after Washington identified what it said was a Chinese spy balloon crossing the U.S. The Confederation of British Industry has won the support of 93% of members who voted at an extraordinary meeting to decide its future. The CBI, the UK's biggest business group, asked members to support a reform program aimed at winning back trust following multiple allegations of sexual assault among staff. Well, a loss of the vote could have led to the organization's imminent collapse. And that's your Bloomberg First Word News. So President Biden has vowed to continue assistance to Ukraine after an explosion at a major dam flooded villages and threatened supplies of drinking water and electricity. Ukraine's economy minister told Bloomberg that the attack should be considered an ecological weapon of mass destruction. Well, she spoke to us in an exclusive interview.
What happened today, without any doubt, it might called and should be called the biggest man-made disaster. And the Russia, they proven once again the whole world that they act like a terroristic state, and I think they used. This disaster, and it seems to be like an ecological weapon of mass destruction.
Well, the Kremlin has denied responsibility for the attack. Joining us now is our Bloomberg senior reporter for international affairs, Mark Champion. So, Mark, thank you for joining us. This is devastating. It's an important story. Do we actually know who's behind the attack?
Not yet. There's an awful lot we still don't know. It is interesting that the US and the UK, very strong supporters of Ukraine, have still not pointed the finger officially at Russia. They're still looking at it. Their intelligence agencies are still looking at it. It may take us a little while. But short answer is no.
So, Mark, evacuations are underway. What do we know about, of course, the flood's impact on people and agriculture in the region?
Well, the impact will be large. A lot of people had been evacuated because the banks of the river Dnipro had become the front line. So there was a lot of trading of artillery and so on. So, there wasn't the same level of population as before the war. Nevertheless, it is devastating. A lot of people, civilians, did live there. They are being evacuated. We know on the Ukrainian side, we assume on the Russian side, we know a lot less. Most of the worst of the flooding is on the Russian-occupied side, the eastern bank, just because of the geology there. The geography is it's lower. In terms of the ecology, we know there's a lot of oil and other pollutants that have floated down the river together with all this water. We also know that the reservoir provided water for irrigation in what is a major area for agriculture and grain production in particular in Ukraine, both sides of the river. And that irrigation will now be lost temporarily, if not permanently.
What does it mean for the Ukrainian counteroffensive?
That is a really good question, and the general consensus seems to be that if the Ukrainians were planning to try and make an assault across the Dnipro, which remember is as much as a mile wide at points, very difficult feat, then that's now become impossible, basically, for now. However, that's temporary. This essentially what the flood will do is, is burst the banks. It's made, any kind of crossing impossible. But then it will subside. The reservoir will empty. When it does, the river will return to its pre-Soviet course. And the net effect of that will be in some places on the river, it will actually be lower than it was before.
Mark, thank you so much, as always, of course, for your great reporting, great analysis. Mark Champion, their reporter for international affairs. Coming up, we're back in Versailles with the IEA Executive Director, Fatih Birol, who will give us his insights on the future of energy. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
China's exports engine run out of steam in May, adding to evidence that global demand is weakening. European stocks are lower. The SEC ramps up its crypto battle, taking aim at Coinbase a day after suing Binance US. Coinbase Chief Executive Brian Armstrong says he's proud to represent the industry in court. And we're live at the IEA's Global Summit in Versailles with the Executive Director, Fatih Birol. Plus, we go to Berlin for the Super Return Conference for an exclusive conversation with the co-president of General Atlantic. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, the U.S. Securities and Exchange Commission is suing Coinbase. It has accused the crypto exchange of breaking rules, including letting users trade tokens that were actually unregistered securities. The SEC chair, Gary Gensler, spoke to Bloomberg's David Weston about the action against Coinbase and Binance.
This is actually a straightforward securities case, but it's in the context of crypto. And let me just say, crypto tokens, the investing public needs that same disclosure, a full, fair, and truthful disclosure, we say. And in the crypto space, it's largely built on a business model that's non-compliant with the securities laws. People are commingling all of the customer funds. It would be as if the New York Stock Exchange is also operating a hedge fund and trading against their customers, or add to it that they don't have proper controls to avoid manipulative trading on the platform by their sister. So here, Binance had a sister organization controlled by Mr. Zhao called Sigma Chain. So absolutely, it's straightforward. Protect the public through the securities law, build confidence and trust, but it's in the context of crypto.
You have said elsewhere that there are certain custody rules here that registered financial advisors have to pay attention to when it's something like Binance. Are you looking at some of those financial advisors for possible violations?
Look, I'm not going to get into any one investigation or case that we haven't yet brought, but I would say this to all of those investment advisors out there that may be interested in trading in crypto. Your client funds, under an existing 2009 rule, have to be proper qualified custodians, and that's not what you have on Binance. Make no mistake. In fact, as we alleged, your funds in custody at Binance, you don't even know really who's where it is. You know that Mr. Zhao ultimately is controlling it, but it may have actually moved it to a sister organization. There's another one that we allege, Merit Peak, that billions of dollars of funds were moving to.
SEC Chair Gary Gensler there speaking to Bloomberg's David Weston. Now, the PGA Tour and the Saudi-backed Live Golf have agreed to a shock merger. It ends a 2-year battle that saw the upstart splash millions of dollars to lure some of the biggest players away from the traditional PGA events.
Obviously, it's been a very dynamic and complex couple of years. And for players, I'm not surprised that, this is an awful lot to ask them to digest. And this is a significant change for us, in the direction that we were going down. But as I'm trying to explain, and I will continue to explain as we go forward, this ultimately is a decision that I think is in the best interest of all of the members of the PGA Tour.
Let's get more now with our Saudi Bureau Chief, Matthew Martin, in Riyadh. So, Matthew, after competing so aggressively, why are Live and the PGA suddenly changing course so dramatically?
Yes, look, as you say, this is a really dramatic change, of course. The war of words between the PGA and Live had been going on quite vociferously in the press and in the courts, and they have managed to keep this deal cooked up very quietly amongst a small group of advisors, and the main principals in this, Yasser Al-Rumayyan, the head of the Saudi Sovereign Wealth Fund, and Jay Monahan from the PGA. But they're doing this now to bring an end to the court battles that have been going on, the fight over players. This has all been getting quite ugly in the press and in the courtrooms. It was threatening to potentially drag on and on through legal proceedings, maybe even involving a subpoena of the boss of the Saudi Sovereign Wealth Fund as well. It was dragging in all sorts of different corners of life, from critics of Saudi Arabia, victims of the 9/11 terrorism attacks in the US. So it was all getting quite ugly and quite protracted, and so this enables them to draw a line underneath all of this and now concentrate on just playing golf.
So, Matthew, who's in control actually of golf now? PGA or the Saudis, and how much will they both be investing in the future?
Well, this is going to be an interesting question to watch as this develops. So initially, under the terms of this agreement, the new entity which is formed, which still doesn't have a name, the main economic voting rights are going to be held by the PGA at the moment. But we do know that the head of the Saudi Sovereign Wealth Fund, Yasser Al-Rumayyan, is going to be the chairman of this new entity. The PIF is going to be investing, they've said, billions into developing golf and to developing new tournaments and new competitions around the world. And they've also said that they have essentially a sort of first right of refusal over investments in new projects. So I think we will see over time that that balance of power may well shift. And with Yasser as chairman, it looks like the Saudis are very much at the top of this new entity.
Matthew, as always, thank you so much for joining us on this important, of course, golf story that feels more like foreign policy in certain cases. Now let's get straight to your Bloomberg Business Flash. And UBS says there will be a grace period of more than 2 years before Switzerland imposes higher capital requirements related to its takeover of Credit Suisse. Now, an increase in capital triggered by the acquisition will be phased in from early 2026 based on an integration plan to be developed by UBS. Boeing will delay deliveries of its 787 Dreamliner after uncovering defective parts. The plane maker says it may affect about 90 already built jets and a few being assembled. Now, Boeing and U.S. regulators have decided if they need to take any action for jets currently in service. The company says it still expects to deliver about 70 to 80 Dreamliners this year. Now, former Diageo chief executive Ivan Menezes has died after a brief illness. He was 63. He had been hospitalized and was receiving treatment for medical conditions, including a stomach ulcer. Menezes joined Diageo at its creation in 1997 and transformed it into the world's biggest premium drinks company during 10 years at the top of the business. He is succeeded by chief executive Deborah Crew, currently the company's interim chief executive.
young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, this is what stocks are doing at the moment. We're seeing a bit of pressure across the board, not only in U.S. futures, but also in European stocks. So let's get that board up. And it's definitely the bigger than expected drop in Chinese exports that's really stoking fears that there are concerns coming up about the strength of global demand because of China. Now, it does seem that signs of fading momentum in the world's second largest economy are weighing on sentiment globally, damping the optimism surrounding China's reopening from pandemic restrictions earlier this year. Now, the conversation is shifting when it also comes to private markets. As big firms get even bigger, a fragile economic backdrop threatens the survival of their smaller counterparts. Now, this dynamic will be a theme at Super Return's 3-day conference, which kicks off in Berlin today. Bloomberg's Danny Berger joins us from the event with an important guest. Danny, over to you.
Francine, thanks so much. I'm really excited for our next conversation. It is Gabriel Caillo. He is head of EMEA, co-president and managing director at General Atlantic. Gabe, thank you so much for joining. You'll have to be patient with all the sound. I mean, it just shows how buzzing this conference is. But look, it's a time of change. It's a time of uncertainty. Is this just a slowdown for the industry, slower deal flows, financing, or has the playbook shifted? Is something really changed?
Listen, I think in a lot of ways, the reset we've seen the last 24 months has been super healthy in some parts of the market and a real challenge in others. And what's unique about what we've just been through is you think of every segment of the market, it's completely shut down, right? We've seen equity capital markets shut down, the debt capital markets have shut down. And I think, one, it gives us a chance to rethink our model. So how are you making your money? How are you driving your performance? But then on the flip side, it gives us an amazing set of opportunities. And as much as we've spent the last 24 months really hunkering down, figuring out how we're going to drive performance of the portfolio, and we feel really good about that, I think what we're most excited about now is as we look forward, we think there's a set of opportunities like we've never seen in our careers.
And what are those?
I think in what we do in growth equity, because we're neither driven by capital markets liquidity or the debt markets, what we're seeing is continued trends. So the same trends that drove our business forever, so digitization and globalization, they haven't changed. Stock markets don't impact that. A potential recession doesn't even really impact that. What has changed is we're finding the same themes, same companies, but half the price as just 12 months ago or last time we met.
So, okay, you're sitting in a good position. You're not worried about some of these financing markets because of the nature of less leverage. For those that aren't, could I say, okay, maybe rates are going to come down at some point next year. We can go back, same as normal. We'll be okay. Is that fair, or is that a little too sanguine?
Interestingly, we barely worry about rates, which I know is counterintuitive for private equity, but our portfolio is mostly unlevered. And even those companies that are levered, the investment thesis is growth. But I think it's a question of how much risk you're willing to take. And it's a hard one to think now that rates are going to stabilize quickly or go down quickly. And I'd be nervous as an investor if that was part of my investment thesis, right? Now, you see it in deal volumes across Europe. We haven't slowed down. Our business from January to now, we've committed almost $6 billion of capital globally. I think the buyout industry is really struggling because the whole thesis of their investment style, which is lower growth companies using cheaper capital, is really challenged by the market.
So what happens to them then? Will there be consolidation?
I think so. It's not, in a way, it's not surprising. Our industry is maturing, right? The industry of private equity has gone through a huge period of growth, which has been massively productive, right? I think it's a product that investors like. It's a product that entrepreneurs like. But as every industry, as it matures, you're going to see winners emerge, and you're going to see people that need to be consolidated. And I think we think about this a lot, and I think the winners are going to be brands and companies and investors that have, one, a strong brand name that represents their style of investing. I think you need to have an origination that's differentiated. So are you finding better opportunities than others, right? Are you creating opportunities for value creation? And I think the last is being a solution provider to investors. And that's one of the big themes, at least I'm hearing in the conference right now, is after this huge period of boom, our investors, so our LPs, are starting to look at actually who's delivering on their promises and who isn't, who is stuck true to their investment philosophy and thesis and who isn't.
So for the consolidation piece, how does that happen? Does it happen by M&A within private equity?
Listen, no crystal ball, but I wouldn't be surprised that what's going to happen is I think those that aren't differentiated are going to really struggle in this fundraising cycle. And you can hear the tone around is it's a harder fundraising cycle than we've seen for the last decade, right? And I think undifferentiated platforms will struggle. And then you have a question is, if you stop growing, are you better off in a stronger, bigger platform, or do you become a niche business? And I think that's going to drive a lot of M&A.
Well, part of the struggle, if you're not fundraising and rates are moving higher, the cost of capital is higher, you have to decide how to handle the companies you currently have. We saw venture capital had a liquidity issue, SVB. Yeah. Does private equity have a liquidity issue?
I think different slices of the market will have some challenges. I think it's more acute in venture because if you look at a venture portfolio, and we do a little bit of late stage venture, most companies need capital to grow, right? It's the nature of those investments is they have to constantly fund themselves. And historically they had SVB, but they also had the equity markets. 1,000 IPOs in 21 in the US alone. That market has I think a meaningful liquidity challenge in the next 18, 24 months. I think they're hunkering down with what they have on balance sheet, but that opportunity will come. And then I think on the late stage of our industry, where people were using leverage to drive their performance, there's a real refinancing question to come, right? Is as debt matures, and it was 3% capital, and now it becomes 9 to 10% capital, what does that mean for the value of your underlying assets?
What does it mean?
I think it means it should be down, and those who are pretending like nothing's changed, I think are not being fully transparent.
So Gabe, your business is very global. You have a lot of investments in China with TikTok, with Shan, with Ant. We heard overnight that Sequoia is breaking up. They're breaking into 3 different entities. That includes separating China from the U.S. There's a lot of geopolitical tensions. What do you think of that separating businesses as a strategy to cope with that?
Yeah, we've been in China 22 years, and it's been a wonderful market for us. It's been a very profitable one. We've seen great investment, and frankly, Sequoia has been hugely successful in the market. I think still today, when we look at the market, I think there's some changes that are happening. It used to be you just invested behind China growth and you thought your performance would come out. I think what's changing now, in our view, is we're still constructive on China, but you need to be more localized. So you need to have real people on the ground that understand the intricacies of the markets. And that means that you also need to be very sector aware of where you're deploying capital. There's certain sectors where the geopolitical risk is just too great, right? We saw it, anecdotally, we saw it with the education market getting completely shut down. But you can imagine the same is true with life sciences, the same is true with the chip industry, right? The same is true with some of the vertical software industry. So separating the business is not something we'd ever consider. We still think China offers great opportunity. And so I don't have specific insights from what Sequoia's done, but I think our investors still want China exposure, and we think there's still a great money-making opportunity there.
How are you looking at growth in China? Because the macro data, I know you're focused on the micro, but hang with me here. The macro data has been slowing down. Have you seen that reflected in the companies that you are involved with there?
Yeah, it's really interesting because I think the data is pretty conflicting, and a lot of people talk about the de-risking of China or even the decoupling of China. The truth is, if you look at trade volumes, they've been stronger in Q1 with the U.S. than ever before, right? So there's some truth in the numbers, and then I think there's what the other things people are saying. Whether there's a softer landing in China, whether some of this recent information and data around exports drives growth, it could. We haven't seen an impact on our portfolio yet. Interestingly, our portfolio is really the Chinese consumer and Chinese consumption. that hasn't slowed down at all, right? And we're seeing really strong rebounds post the very tight COVID lockdowns.
All right, Gabe, that's all we have time for, but I'll give you a break. I know we have a panel together, so you don't get sick of me. We can take a little bit of a break here.
Look forward to it.
Gabe, thanks so much, Francine. That's Gabrielle Cayo, head of EMEA and co-president at General Atlantic.
Yeah, wonderful interview, as always, Danny. Great work out there. Danny Berger with Gabrielle Cayo, General Atlantic's co-president and head of EMEA, as Danny was just saying. Coming up, crypto crackdown, a second lawsuit in 2 days as the top securities regulator sues Coinbase. We'll ask what this means for the crypto world. This is Bloomberg. So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the IEA's 8th Global Annual Conference convenes today against a backdrop of waning demand from China, production cuts from Saudi Arabia, and an intensification of the conflict in Ukraine. Global leaders in the sector look to get back on track with energy efficiency, the theme of this year's event. Well, we're delighted to be joined by Fatih Birol, Director of the International Energy Agency. Fatih, as always, thank you so much for joining us. How far are we from reaching the net zero in 2050? How much progress have we made since last year?
Thank you very much. In fact, when we look at today, the global energy sector, there is one trend which is very obvious, namely a new clean energy economy is emerging, and emerging faster than many people think. Just let me give you a few examples. Last year, about 90% of the new power plants built in the world were clean. Only 10% were fossil fuels. Electric cars. 2 years ago, 1 out of 25 cars sold in the world was an electric car. 1 out of 25 2 years ago. And this year, 1 out of 5 cars sold in the world is an electric car. Heat pumps going very, very strongly. And also, nuclear power is making a comeback, a very strong comeback across the world. So, when I look at the all energy sources, of course, we will need oil and gas for a few years to come, next years to come, but we see a clean energy going very strongly, but still not fast enough to reach our ambitious climate targets in the world.
Fatih, we also had this OPEC meeting over the weekend. What is your reaction to the Saudi decision? How far will oil prices keep rising?
Yeah. Of course, it is up to OPEC members, producing countries, what kind of production policy they are going to follow. But when we look at our numbers, which is taken as the benchmark for the real players in the oil markets, it says that under normal conditions, second half of this year will be tight, already tight because of the strong demand, about 2 million barrels per day growth, which is similar to many other organizations, and supply is not going that much. So on top of that, having a production cut might exert pressures, upward pressures to the prices.
But do you have a bearish view overall on how the oil market is evolving given recession fears and demand from China?
I think if there are many uncertainties as usual when it comes to the oil markets, and if I have to pick up one, the most important one, it is Chinese economy. So when I say more than 2 million barrels per day of growth we expect this year in global oil demand, 60% of that growth set to come from China. If Chinese economy weakens or grows much lower than many international economic institutions believe, Chinese economy believe, of course, this can lead to a bearish sentiment. But with a normal business as usual economic growth pattern of China, we may well see also with this production cuts upward pressure on the prices.
Fatih, thank you, as always. Fatih Birol, the director of the IEA. We'll have plenty more on the markets coming up. Bloomberg Surveillance Early Edition continues in the next hour, and this is Bloomberg.
Middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Downbeat data. China's falling exports stoke further concerns about the strength of global demand. Meanwhile, the OECD warns the world economy is set for a weak recovery this year. Citigroup CEO Jane Fraser visits Beijing this week, joining other Wall Street executives to travel to China despite growing geopolitical tensions with the US. And the SEC doubles down on its crypto crackdown, taking aim at Coinbase a day after suing Binance. Coinbase says it's willing to take this legal fight to the Supreme Court. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. There's plenty to talk about today, Kriti, from data out of China, geopolitics around China, the crypto story, of course. All that very much in the mix, not having a huge impact on markets, perhaps, where we see equities looking a little sluggish this morning.
A little bit sluggish, and I think fairly so, perhaps, as we talk about those global growth concerns laid out by the OECD, laid out by China as well. That's certainly denting a little bit of sentiment, I want to say, on both sides of the Atlantic and arguably Asia as well. Futures down 0.1%. Look, Anna, we don't see a ton of momentum in either direction in the last couple of days, especially at this time of hour. But where you are seeing a little bit more direction is in the bond market. The two-year yield really testing that 450 level, and that is crucial as we talk about just how much closer it gets to 5%. It has everything to do with bets about just how hawkish the Federal Reserve will be. Because look, they're dealing with a very hot labor market, but also dealing with those growth concerns that are now really seeping into the United States from around the world. Nevertheless, 2 basis points higher on the front end of the curve there. So seeing a little bit of sell-off both in the stock and the bond market. As those yields move higher, though, you are seeing a little bit of a dent in the dollar as well. Slight weakness, nothing I would write home about, down about 0.1%. Again, in the face of that decelerating global growth environment, the dollar tends to be the play. So really keep an eye on the greenback there. NYMEX crude gets interesting because, again, if technical levels are driving the bond market, Anna, they're driving commodities as well. Even if OPEC Plus did kind of put, in theory, a floor under prices, you're starting to see NYMEX crude kind of test 70 again, 71 handle for that commodity, only higher by 0.2%. So, Anna, if there's a takeaway from this markets board, I think what I would say is no conviction in the trade just yet, but perhaps souring momentum.
Yeah, we certainly see a lack of conviction today here in Europe, Chrissy. This is the European expression of that. The London market entirely flat. A bit of downside risk coming through on the DAX and the CAC. Outperformance, though, coming through in Spain. And when I show you the other assets in focus today, you'll see why that is. A big focus on retail here in the European trading day, and this has very much to do with Inditex. So the retail sector is the sector that really outperforms. It's up by 2.4%, really stands out compared to others on the day. Inditex is the owner of the Zara brand, of course. That stock up by 5.9%, and it is a giant of the Spanish market. So as a result, it lifts that whole geography. It also lifts the sector. And what's really interesting here, Chrissy, is we all know that there has been a lot made of the future of retail being online. But it's the actual bricks and mortar stores making them bigger. Apparently, that persuades people to buy more. Who knew? And that is playing out well for Inditex. We had one analyst describing the results from Inditex as stunning this morning. Here's the dollar actually on the rise against a falling Turkish lira. So weakness in the Turkish lira. Is the government in Turkey about to give up on a very expensive project plan that they had in place under the former finance team? Are they about to give up on that? And that's leading to some weakness in the currency here. And Brent crude is, as you showed with WTI, just showing a little bit of positivity, Chrissy. We had seen it weighed down in the earlier part of the session by the data coming out of China, exports and imports falling. But within that, really interesting detail about imports of commodities, whether it is oil or copper, or oil or gas, or some of the other commodities that, of course, China imports. We actually saw those remain pretty robust in the most recent set of data.
Yeah, certainly a topic that's worth diving into when we talk about the global ramifications of those kind of numbers. To build on your point, Anna, Chinese exports falling more than expected in May, adding to risks in the world's second largest economy as global demand weakens, as you just laid out, Anna. Joining us now, Bloomberg Shanghai Bureau Chief Charlie Zhu. Charlie, walk us through what this actually means in terms of just how quick the deceleration in China is really taking place.
Yeah. Exports, as you know, at the beginning of this year, served as kind of a growth engine for China, thanks to the lifting of all the, 3 years of COVID restrictions, But quickly they are showing signs of losing steam. As you just mentioned, it, fell the first time in 3 months, and also, it's sharper. The drop in May was sharper than expected. So basically, we're seeing, exports to its, to China's main overseas markets, from U.S. to Japan to Southeast Asia and some European countries are seeing, saw double-digit decline, which is, a bit, not a good sign for the economy. And also at the same time, definitely raised the question whether China can meet its, growth target for this year, which is at about 5% this year. And there are a lot of, debate at the moment whether China needs to roll out a new round of stimulus. That's something we'll have to wait and see.
Yes, and thinking about that, Charlie, what are the measures that the Chinese government is considering taking to shore up the economy? For the last few days, in the early part of my trading day, all the way through yours, no doubt, the big question in China has been whether we'd see further stimulus coming through, in particular from the PBOC.
Yeah, there are a lot of speculation or expectation that China may consider, cutting the reserve requirement ratio for banks, to free up more resources for lending to support the economy. And also there's a lot of gossip that China may opt to cut its interest rates as soon as later this month or early next month. But it's a tough question. We don't know whether PBOC will do that now, given the rate differential. I mean, the differential between the U.S. and China Treasury yields, remains pretty big. If you you announce big cuts, probably that could lead to capital exodus, which could risk destabilizing the whole country. There are some other options, available, such as a further round of property easing, or more targeted support measures for certain industries, from EVs to other durable goods. So anyway, this remains a focus of everybody's discussion at the moment.
Yeah, certainly a lot of factors to juggle in terms of the global ramifications. And remember, in the 08-09 recovery, China's infrastructure plan was a really big part of that story. Bloomberg's Charlie Zhu in Shanghai. We thank you, as always. JP Morgan CEO Jamie Dimon says the Biden administration is pursuing the right strategy on China as well. Dimon spoke in Washington yesterday, fresh from a trip visiting clients in China last week. Bank. Joining us now is Bloomberg's Asia government and politics reporter Rebecca Chung Wilkins. What did we learn from Jamie Dimon's visit? He has very famously said, look, we're going to be in China in the good and in the bad. What are the developments from his trip?
Absolutely. Well, Dimon very complimentary about Biden's administration's policies when it comes to China, particularly stressing that Blinken and others are rightfully talking about national security, rare earths, semiconductors, and unfair trade practices. But of course, as you say, coming on the heels of this trip, and really the remarks underscore this tension, I think, for not just Jamie Dimon, but all US banks to have to balance, to some extent, the need to have maintained exposure into China and into the Chinese market, whilst also managing this increasingly hawkish environment. And we did see, even after those sort of compliments from Dimon about Biden's approach, we did see some lawmakers still criticizing that Dimon didn't go far enough, that he's so-called whitewashing China's aggression. And it particularly comes at a time when we are seeing what the US categorizes unsafe maneuvers around certain US military vessels that are conducting freedom of navigation operations.
So we've seen Dimon, then Rebecca, in China. We've seen Musk in China. We've seen a lot of US executives in China recently. Citi's Jane Fraser, is going to be visiting China as Wall Street is seeking closer ties, we understand. So what's the drive behind her visit?
Absolutely, and not just Wall Street seeking closer ties, but Beijing too, very much rolling out the red carpet. I don't think it's a coincidence that we are seeing this flurry of activity, and in part it is to combat that skepticism that followed the message from authorities, a couple of months ago at the Boao Forum, which is sort of China's equivalent of Davos, really trying to lure foreign investment back in. In part, this is a Wall Street effort after revising their profits around China, cutting some jobs and some exposure to China too, again trying to sort of repair that relationship. And Jane Fraser, again, in those remarks, stressing that they are optimistic about the financial development in China, as well as expanding their onshore operations too. And it's really those onshore operations which are critically in focus, particularly because we're coming off the back of this crackdown on consultancies firms, which are among count US banks among their clients too. So this whole question of the ease of doing business will be critical for Fraser and others to really determine on these visits.
Rebecca, thanks very much. Bloomberg's Rebecca Chung Wilkins joining us there with the latest on that visit and a number of China themes, in fact. Now, let's talk about the crypto sector, because crypto investors are digesting the SEC's enforcement actions, and there have been plenty of them. First, against Binance on Monday, and then against Coinbase yesterday. Bloomberg's David Weston spoke with the SEC chair, Gary Gensler, about the two lawsuits.
I think the crypto industry more broadly, if it's going to have any success going forward, has to come into compliance with basic public policy about disclosure, about avoiding conflicts, about properly segregating customer funds, and guarding against fraud and manipulation.
Gary Gensler there. Emily Nicole, our crypto reporter, joins us now. Emily, very good morning to you. So tell us more about the SEC and what it alleges in this case against Coinbase and how it's responded.
So for Coinbase, it was a pretty straightforward complaint from the SEC. It's that Coinbase does several things under one house, things that in traditional finance we might see companies do under several separate units, and the SEC disputes that. It also says that several cryptocurrencies on Coinbase's platform are unregistered securities, and so therefore, with Coinbase not being a registered securities broker, it doesn't have permission to be selling those to the public.
Emily, the timing here is fascinating, because isn't 2023 supposed to be the year where we get the digital yuan, the digital euro, potentially? In that context, how deep could the crackdown on crypto get in the US specifically?
Well, to be clear, things like the digital euro and the digital yuan, those are central bank digital currencies. They're quite different from cryptocurrencies like Bitcoin and Ether. Where the US is concerned right now is, how many of the crypto companies in our space are operating without real oversight from them, ways that they can, make sure that consumers are protected. And so that crackdown is really coming now in force. Because lawmakers in Washington are so tied and split over whether or not they could even pass crypto legislation this year or even next year, this is really the only route the SEC sees that it has.
Emily, thanks very much. Emily Nicole joining us there with the latest analysis on the Coinbase part of this SEC front against crypto. We'll be hearing from the Coinbase CEO, Brian Armstrong, today on Bloomberg at 1:30 p.m. Eastern Time. So interesting to get his take. He has said, of course, he's willing to take this to court. Coming up on the program, chip makers falling after a monster surge this year. We will speak to HSBC's Frank Lee with a street-high price target on NVIDIA. We'll talk AI. We'll also be speaking to Gordon Shannon of 24 Asset Management and why he sees more risks of a hard landing. We'll also get his take on the wave of issuance that's due to come from the Treasury and what that's going to do to other assets. Plus, we'll be live from the Super Return Conference in Berlin. An interview with the Ares Management CEO. That is coming up shortly on this program. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, all the rage around the stock market has been about concentrated gains in tech. One name getting a lot of flack for that, NVIDIA in particular. We know we've seen that AI kind of storm, that frenzy really capture those shares and with it take the benchmark even higher. But we're going to evaluate just how high those share prices can go in just a minute. I want to bring to our audience a chart that I find very, very interesting. For our radio audience, stick with me here. We're looking at a price chart of NVIDIA shares with the best price targets, essentially the 12-month price targets on Wall Street. And you can see they've kind of followed a similar pattern until this kind of most recent announcement on May 24th, this big AI push from NVIDIA. So the shares, of course, rallied to 386. The price target, the average price target on the street, 452. But there is one name that has the street high above them all, shooting for even more upside of $600 a share, signified by this green dot right here. And joining us with that street high price target right now, Frank Lee, HSBC's head of Asia Technology Research. A pleasure to have you on the show, Frank. Let's start with the promises made by NVIDIA here. Your case largely rests on their pricing power. Why does NVIDIA have that pricing power, given that there's so many entrants into the AI market right now?
Great, that's a great question. I think, what's really shocked us, even, by our standard, was just the pricing power that NVIDIA was able to gain this early on in the AI race. I think, what they've demonstrated was just that they can basically take nearly the majority of the industry profits, at least its early stage of AI. So I think if you think about this in perspective, when they sell a traditional gaming GPU, which is what their core business was in the past, the average selling price is somewhere about, anywhere between $1,000 to $3,000. But today, if they sell that AI GPU to be used in an AI, your average selling price is now $20,000 to $30,000. So you're talking about a huge magnitude of increase. And I think that's what really was a surprise was, how strong this bargaining power is. So I think that is what we were more bullish going into into seeing this trend. But we were also quite surprised by the magnitude of its its revision that we saw for the upcoming quarter. And I think it's not over. I think this is just the beginning. We will continue to see them dominate this year. It's really a monopoly in terms of solutions. And I think what's also strong, what's also probably underappreciated is the ecosystem they're working on right now. They are doing not just the GPU chip itself, they're actually selling more systems now. And that is something that they are continuing to push more. And they've also got the software ecosystem. So it's really a very complete ecosystem.
Well, a lot of promises being made, a lot of assurances being made by NVIDIA, but Frank, that requires a lot of investment. Let's talk about the infrastructure here. In a decelerating growth environment around the world where business investment is dropping significantly, does NVIDIA really have the infrastructure and the investment to scale up in the way that they're saying that they're going to?
Yeah, again, it's also a very good question in the sense that I think if you look at one of the concerns that investors had is that, to your point, which is the overall macro environment is getting weaker, the hyperscalers, the data center guys, they're not raising their overall capex per se. So I think this led people to kind of think that this is going to lead to a slower ramp. But what we're seeing, though, is that the budget is being reallocated today from traditional server and data centers toward AI. And so that continues to drive the strong growth that we're seeing for NVIDIA. And I think it's something that people are going to continue to prioritize over the immediate future as well.
Okay, good morning to you, Frank. What limits the pace at which AI opportunities can grow? So if we're looking at your price target, we're looking at what we've seen on NVIDIA already, is there a limiting factor, a growth limiting factor that you're watching to make sure that we don't kind of bump up against that in the case of NVIDIA or the broader AI space more generally?
Yeah, I think that the main thing is really just about, the beginning of ChatGPT was just kind of the taste of AI, and that really kicked off. I think the best way to describe this is just an arms race. It's an arms race between the hyperscalers right now. They're prioritizing AI. So the question is going to be, does the longer term, I think beyond this initial phase is going to be the overall practical applications, right? But I think we're in the early stages of this arms race. So I think, for the immediate future, this is something that none of the companies can afford to miss out. So you're seeing all the big companies are engaging in this early stage arms race, and effectively NVIDIA is right in the center of this and selling basically to everybody in terms of the beginning of this race.
So practical applications could be a limiting factor further down, but at the moment we are in the early stages, you say, of this AI arms race, as you described, Frank. Yesterday we had interesting conversations with guests about whether this was like 1999, but instead of .com, about AI. Some suggest, no, actually it's more like 94, and there's a lot more to play for here. I don't know if you look back at historical parallels, whether they prove useful at all.
Yeah, I mean, I think historically it's always good to have a reference, but I think it's also at the same time there's going to be different dynamics. I think with this, if you think about just 2-3 years ago, there was a lot of enthusiasm around metaverse, right? And ultimately 6 months later, people, even today, we're not really talking too much about metaverse because the practical applications didn't really catch up and the investments didn't really come through. I think with AI, we have a different story. I think we're really at the beginning of a transformational period. We are, going to see a lot more investment, and already today we're seeing it. So, NVIDIA is the best example of that, delivering on the investment and the upside. We haven't really seen that happen in with the enthusiasm that we saw with metaverse. We didn't have anybody that really benefited to the same extent we're seeing today with the AI.
Yeah, definitely. Fundamental investment, both, I want to say, from the government side, but also from the corporate side, no doubt about it. But Frank, what changes your price target here? What is the biggest risk that you're seeing? And put some numbers on it. How much of damage could that risk put on the stock price?
Yeah, I think the key concern is going to be probably in an immediate term is after the initial phase of, this initial phase of AI is really about training All right. And then there's going to be, the second phase, which is going to be more about inference when it comes to AI. And there's going to be, I think, the next stage that people are going to kind of recheck is to see if NVIDIA's dominance that we're clearly seeing in the training part of this phase can continue into the inference phase. We are going to see, competitors, even some of their own customers, such as the hyperscalers and the cloud customers, thinking about designing their own chip, which is based on what they call ASIC, as an application-specific IC, to see whether or not they want to do this themselves in-house. So I think that's going to be probably the next major checkpoint. But I think we're probably, a good, at least 1 to 2 years away from that stage. So I think, in the near term, we're going to continue to see very strong momentum from NVIDIA.
Okay, Frank, thanks so much for joining us. HSBC's Frank Lee joining us to talk about NVIDIA and the broader opportunities around AI. Really fascinating conversation there, then, Chrissy. Thinking about the practical applications, and that could end up being the limiting factor. That could put a top on the extent to which we can all continue to get excited, and we seem to daily, about opportunities in AI.
Yeah, I think that excitement daily that you just pointed out, Anna, is so crucial here, because if you look on the Bloomberg terminal about these analyst consensus, I am looking at 50 buys, 8 holds, and only 1 sell. Wall Street is extremely bullish on this stock when you look at the research.
Yeah, absolutely. And the pricing power that he was describing, quite incredible, going from selling GPUs to the gaming sector for $1,000, $3,000 up to $20,000, $30,000 when you're selling these for AI purposes. Just shows that it kind of depends who's buying it.
Yeah, the pricing is really interesting, and then you have to kind of factor in the inflationary story as well, and it turns into a very global story very quickly, which brings us, by the way, to news from around the world. Let's get to the first word here, and a lot to digest. Ukraine specifically rushing to evacuate people from flooded areas after that explosion at a major dam in the south of the country. The blast flooded villages, inundating thousands of buildings and threatening supplies of drinking water and electricity. Kyiv has blamed Russia. The Kremlin denies responsibility. In Canada, more than 100 wildfires continue to burn out of control. Thousands of people in Quebec have already fled their homes, and more evacuations are expected today. The effects are being felt as far as 500 miles away. According to Swiss air quality Q-Air, New York was the most polluted major city in the world Tuesday night, as smoke from the Canadian wildfires blanketed the city in haze. The global economy is set for a weak recovery, according to the OECD. The organization's latest economic outlook forecasts a 2.7% expansion of world output this year and 2.9% in 2024, both below the average in the 7 years before the pandemic. The OECD says the war in Ukraine, the shocks of COVID, persistent inflation, and the restrictive policies of major central banks are all weighing on the recovery. The caution follows similar outlook from the World Bank. Elisa Mall, the chief investment officer for Michael Dell's family office, wants to diversify her portfolio. The firm is poised to absorb an influx of cash and stock worth more than $20 billion after Broadcom closes on its $61 billion purchase of VMware. The cloud computing company counts Dell as its largest shareholder. Mall says she'll use the proceeds to add more real estate to the portfolio and also expects to invest some in credit. Interesting, Anna, to start to see a little bit of this consolidation and where a lot of these really wealthy family offices are actually investing their money in a time when I would say regular investors are having a really hard time finding an entry point both in the stock market and the bond market.
Yeah, interesting that she's looking at credit, also looking at real assets, and we hear a lot about that being talked about here in Europe, whether it's infrastructure or beyond. So we'll continue to monitor that. Coming up on the program, Gordon Shannon joins us of 24 Asset Management. He's going to talk to us about fixed income markets. We spent a lot of time talking about how we might see a lot of issuance at the short end, in particular of the Treasury curve, and what's that going to do to trading around Treasuries. That's going to be in focus for us next. We'll talk to Gordon Shannon about that. This is Bloomberg.
politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Downbeat data. China's falling exports stoke further concerns about the strength of global demand. Meanwhile, the OECD warns the world economy is set for a weak recovery this year. Citigroup CEO Jane Fraser visits Beijing this week, joining other Wall Street executives to travel to China despite growing geopolitical tensions with the United States. And the SEC doubles down on its crypto crackdown, taking aim at Coinbase a day after suing Binance. Coinbase says it's willing to take this legal fight to the Supreme Court. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest in terms of headlines at the micro and the macro front, but I have to say at the top of the agenda, it does feel like those global growth concerns are really taking precedence.
Yeah, absolutely. A lot of the different names for that global growth concern, a non-recession. Recession is the way that somebody at Apollo put it over the last 24 hours. So a lot of people finding their own ways to describe what lies ahead for us. This is what European equity markets are doing with that kind of information. Not very much today. Sluggish trading across stocks, down by around 0.2%. One sector that's not sluggish, though, is the retail space. So selling clothes in particular in Europe seems to be doing pretty well today. So the retailers up by 2.5%. And the reason for that is the numbers out of Inditex. Inditex is the owner of the Zara brand. Their numbers described as stunning by one analyst. And it seems to be that the expansion of their bricks and mortar stores is persuading consumers to spend more money on each trip. And that seems to be working well for them, and certainly that was reflected in the latest earnings release from that business. This is the dollar on the rise, but against a falling Turkish lira, down by around 7% on the Turkish currency. Are we seeing the government coming to the end of a rather expensive intervention program in the Turkish currency with the arrival of a new finance minister, a Wall Street-friendly finance minister? That is the question that many in the markets are asking. Kriti?
Yeah, and I think sentiment that perhaps is flooding into the U.S. trading day as well. Anna, you described it as sluggish. I think it's the perfect word for futures action as well. They're virtually unchanged right now on the S&P 500, although we were down about 0.1%. So if you're really looking tick by tick, perhaps pairing those micro losses, 42.88 on those futures contracts for the S&P 500. I would argue more movement, though, in the bond market, especially when you look, again, tick by tick on the front end of the curve, seeing a little bit of a sell-off. 449 really hitting against that 450 technical level, and that's really what you want to watch as we talk about what is getting priced in for the Federal Reserve in just a couple of days. Just how hawkish can they really be when you're starting to see these global growth concerns, and specifically services data in the U.S. coming back down. About 2 days ago, we got those numbers. The dollar taking its cue from that story. What's interesting, though, is that if you were really worried about recession, really worried about a slowdown, wouldn't the greenback, in theory, at least see a bigger bid? And yet we are not seeing that at the moment, perhaps a function more of positioning, which brings me then to the commodity story, because that's really where you're going to see those growth concerns, specifically coming out of China. NYMEX crude trading at about a 71 handle, Anna, up about 0.2%.
Okay, let's talk about the global growth story and fixed income markets. Gordon Shannon joins us, 24 Asset Management Portfolio Manager. Gordon, very nice to have you with us this morning. Let me get your take on the global economy then, because I'm drawn to a few different bits of news around this. Various voices at Apollo calling this a non-recession recession or a recession light. I also saw that a Bloomberg survey of analysts puts a 65% chance on there being a recession in the next 12 months. How are you thinking about the path ahead and the possibility of recession?
So it's such an extremely well-heralded recession. As you say, a number of experts talking about it. We look at various asset prices and the yield curve, which I pay particular attention to. The inversion of 2s, 10s has been waving the red flag for almost a year now. But yet we still haven't had, away from asset prices, away from surveys of outlooks, we haven't had the hard economic data. So I look, for instance, at the trend of credit rating agency upgrades to downgrades, and whether we look at Europe or the US or emerging markets, the ratio of upgrades to downgrades is still improving. So we'd expect to see more deterioration there. Unemployment, very low levels in the US, and it's barely shifted elsewhere.
Okay. So not necessarily seeing cracks that we might anticipate seeing, given how long we've been talking about the coming recession. Let me ask you about the supply in treasuries markets then. Get back to the focus of your portfolio and treasuries. There's been a lot said about supply coming in and a lot of supply expected at the short end. We now have some clarity over what it is that the Treasury is going to issue and when. Are they doing what you thought they would do? For some people, this was going to be a big wave of issuance, and then they saw the numbers and it wasn't as much as feared. What's your expectation?
Yeah, I mean, they have to rebuild the government coffers, the Treasury general account. I think what's interesting for me is the focus on bills. So almost all of that issuance is going to be sub 3 months. And that's mainly because that's where the demand is. They can attract money from money market funds. If they tried to issue longer than 3 months, given expectations about what the Fed might do, it's just not, it'd be difficult and they'd start to move the price. There's also a slight wonder about whether that's almost a directional play by the Treasury, that they expect rates to be coming down. It's going to be a serious issue for the US government as they refi their massive debt load at higher and higher rates now, higher for longer. That's going to eat up more and more of their revenue.
Gordon, for our international audience, though, connect the dots here. If you are seeing this kind of deluge of issuance at a time when you've seen credit markets really deal with this kind of eroding of liquidity, shouldn't that, in theory, if not perfectly, at least in some ways, kind of fix the problem of, in terms of things like bid-ask, for example? Why is that not a perfect match?
I think really, going back to this point about it being a well-heralded recession, but yet we're not seeing that in the underlying data. And you talked earlier about how well consumer discretionary stocks are doing. I think it shows that the system's still absolutely awash with liquidity. So despite the fact that we've had 500 basis points of rate hikes, there's still a lot of money out there, which suggests to me that whether it is a pause or a skip, there's still more QT to come.
Well, speaking of QT then, how are you looking at perhaps what's going on in the U.S. bond markets with then global bond markets? Let's factor in, say, the BOE, for example, taking a very different stance than the Federal Reserve. Are you then seeing international bond markets not necessarily in sync with each other? What are the dangers there?
Yeah, indeed. Last month was a fairly torrid month for gilts. While we didn't have any headlines at the level of government incompetence that we had last September, we had similar levels being approached from gilts and a serious underperformance of gilts versus bonds or treasuries. Now, we can point to the inflation data that came in the last week of May in the UK, and core inflation was much higher than expectations and higher than the previous month. But actually, the bulk of the move had happened earlier in the month. And I think there it comes down to the rhetoric coming from the Bank of England, a number of the members talking about how they're still worried about inflation, how more needs to be done. And the last comment they made about quantitative tightening was that they may increase the pace of the active selling of gilts.
Going from the gilts market to other UK markets, so sterling credit, and thinking about sterling investment grade, you have a preference for sterling credit because of some technical factors.
Yeah.
What's the expectation?
So the one piece of good news there is that the Bank of England has finished its selling of corporate bonds. So that seller in the market has gone away, and there's a real dearth of supply from corporates into the UK sterling market, and we expect that to continue. Meanwhile, there's demand from pension schemes who are now in a position to de-risk, to seek to be bought out, and that increases their demand for sterling investment grade. So as long as we're careful about what the gilt market's doing, and it doesn't force these schemes, the liability-driven investment schemes, to have to raise too much collateral, the technical's pretty good there.
We all talked a lot about those, I remember, back in the autumn of last year. So the technicals look pretty good as far as you're concerned. How does that leave the balance sheet at the Bank of England different to the other big balance sheets of central banks? I'm thinking of the ECB, for example.
Well, it leaves them with gilts, and they've got 800 billion of gilts. They're currently allowing that to reduce at 80 billion per year, 40 billion of active sales, and around 40 billion of maturities. Perhaps they're going to increase that, but they're done with their corporates, whereas both the Federal Reserve and the ECB still have a huge amount of corporate holdings, and while they're letting those roll off, they haven't been actively selling them. So there's a lot of work there if they want to move those off their balance sheets.
Gordon, thanks so much. Thanks for joining us. Gordon Shannon of 24 Asset Management. We appreciate your time, and thanks for talking us through your thoughts on bond markets. Now, coming up next, we'll bring you our live interview with Ares Management CEO Michael Arrighetti from the Super Return Conference, Private Markets in Focus over there in Berlin. Plus, our coverage of the Bloomberg Invest Conference kicks off later today in New York. Speakers include Stanley Druckenmiller, Henry Kravis, Dawn Fitzpatrick, and Nassim Nicholas Taleb. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Certainly, the private equity boom of the last 10 years has been driven by a lot of firms that were not actually driving alpha, but were really just taking advantage of levered beta. And free money allows you to do that. We're no longer in a free money environment and don't anticipate we will be for many years to come. And so our industry is going to have to go back to good old-fashioned creating value through operational improvement, buying well, finding good underloved companies, and driving value that way.
That was Apollo Global Management Co-President Scott Kleinman speaking to our colleague Danny Berger earlier at the Super Return International Conference in Berlin. A fascinating conversation there. I was taking copious notes. Danny joins us now for another really interesting interview with a leader in the private capital world. Danny?
Hi, Anna. Thank you so much. That's right. We have another fantastic interview, a giant in the private capital world. It is Michael Aaron Getty. He is, of course, the co-founder and CEO at Ares. Mike, thank you so much for joining.
It's great to be here.
You know, there's been a lot of optimism around here, but of course, the general environment is pretty difficult. Are we headed for the end of the golden age of private equity right now?
Interesting you phrase it that way. I'm not sure we were ever in the golden age of private equity, but things are definitely different in a couple of ways. One, the tone is clearly more optimistic than last year, despite the fact that it's still a tough market for PE. I think that's probably because people sense we're coming to the end of rate hikes. Buyers and sellers are going to be able to agree on value a little bit more easily, and I think there's optimism that the transaction machine and fundraising will pick up.
Well, you're a credit guy, so by your nature, you're maybe a little bit more on the pessimistic side. Yeah. Do you share that optimism?
I do, actually, and we're seeing that. We spend a lot of time, obviously, in the private markets where we can see the transaction pipeline build. And I would say looking out 6 months, we're seeing more deal flow already working its way into the system.
Okay, and so do we then have that break? Because right now at the moment, it's buyers don't want to buy because it's too expensive and sellers don't want to sell at a lower level. What actually breaks that? What happens in the next 6 months that allows the flow to continue?
You need rate stability, because rate stability means price stability, and price stability at least means you can get a price and know what it's going to be. It may not be the price that you want, but at least you can start thinking about transacting.
Okay, so it's not necessarily the fact that we're at high levels of rates, it's just that they keep moving up, so you need that to stop.
It's the uncertainty. You need more certainty and more stability in the backdrop, and I think you need, therefore, the markets to calm down.
Yeah.
But I'm optimistic.
But I mean, not even the Fed knows really what's going to happen in this economy.
Well, they may know, but they don't know what's going to happen in the economy, but they know what they're going to do. They're just not telling us yet.
Yeah, okay, fair enough. So in terms of looking at deals then, if you're like, okay, in 6 months' time, things come back on the market, what will be the opportunities at that point?
Well, we think about the market opportunity in 3 different ways: public versus private. So much of last year, we were actually buying things in the public market because they were offering better value. Now they've shifted back to the private market. And then in the private market, it's primary versus secondary. And right now, most of what we're doing is what I would call secondary, meaning we're a liquidity provider to owners of assets and companies that can't access the equity markets. They're not selling, and therefore they need some kind of creative capital solution to help get to that new rate environment. Once we get to that new environment, the primary machine will turn back on, and then it'll be back to the regular way flow again.
Is there a sense that folks in this industry are having a liquidity issue as rates move higher and they need to plug the gap until we get stability?
100%. Even for the best companies. I mean, no one has seen 500 basis points of rate increases at this speed. And debt service coverage is a real issue. It's ironic because we're actually seeing some of the highest quality companies most liquidity constrained because they were the ones that were able to command the highest leverage. So it's an interesting set of conversations we're having versus prior cycles.
Do some things fall by the wayside then, where areas others don't step in to help? And what does that look like?
There's definitely going to be dispersion of outcomes, and there will be the haves and have-nots. Some who deserve it will get capital. It will be expensive. It will come with a lot of structure. But yeah, I think there will be some that will be left out, certainly.
What does it mean to be left out? Is that more consolidation in the industry? Is that some funds just die?
I think, I don't know, dying. I mean, because these are that's very somber.
Really
it's very here we were all optimistic, and you had to bring up debt.
Changed the tone.
Yeah, I think consolidation is inevitable. We've already seen major consolidation in alternatives. We've seen it in traditional asset management. And now we're actually seeing traditional managers buy alternative managers, and I would expect that to continue. As a large manager, my own view is I think the large will get larger. We've seen in every cycle share consolidation, more capital flows to fewer people. And I think those that are really niche-y, really nimble, very product specific, they'll have a good go, but I do think there are going to be a lot of people in between that can't differentiate on approach or outcomes that may not be able to get to their next fund.
So then you do have this upswell of maybe some companies that don't get that support, other funds that, again, can't continue in this environment. What does that mean in terms of opportunities? Is there anything for you there?
Yeah, that's what we would consider to be the rescue capital gap financing opportunity, and we're seeing that in real estate, infra, and corporates. I think that's going to be a big part of the deployment opportunity for the foreseeable future, really helping equity owners bridge to that new rate environment where they can monetize or at least access the equity capital markets again.
Mike, you also have a sports fund that you started. It's been a lot of sports news. There was the Live Golf and PGA consolidation. To you, does this kind of show, hey, perhaps there's more deals to be done in this industry than we originally thought? There are more things on sale.
Yeah, it's funny. We launched our sports enterprise in earnest in the middle of COVID, thinking that we could be a real creative solution provider to teams, leagues, owners, networks. Everyone was trying to deal with the new reality of people not going to live events. We now know that the global demand for sports and unscripted content is growing at a faster pace now than it was pre-COVID. I think the Live PGA DP merger is just another indication that there's a move towards global scale in a lot of these assets, and I think that's a good thing for everybody.
In terms of categories of sports, you of course have McLaren, you have the F1, there's been some chatter around football. Anything that you're particularly interested in right now that presents an opportunity?
No, it's actually, it's been a real fun exercise for us. We're invested in Formula One, we've invested in MLB, we're invested in the NFL, F1. Rugby in Australia, cricket in India. There's a whole host of global opportunity. Each league, each team, each country presents a unique set of opportunities and challenges. I think that's one of the reasons why we're uniquely positioned to do that kind of business.
Well, I hope you're a sports fan, because that's some fun due diligence.
I'll tell you, it's not very hard to get people to work on this fund internally.
I can imagine. Probably good for recruiting.
Yeah,
you, Mike, that's all
absolutely.
we have time for.
Okay.
Thank you
Thanks.
so much
Great
for
to see
joining.
you.
Really
Appreciate it.
And Anna, with that, I'll bring it back to you. That's Mike Aaron Getty.
Danny, thank you very much for being based. Danny Berger on the road for us at the Super Return Conference. We'll bring you more from that conference throughout the day and also tomorrow, including an interview with Joe Taylor, CEO of Ontario Teachers Pension Plan. Up next on the programme, UK Prime Minister Rishi Sunak making his first official trip to Washington as Prime Minister. We'll get more on that next. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Well, it's official. Former Vice President Mike Pence has announced he's challenging his former boss, Donald Trump, for the 2024 Republican presidential nomination. Pence made the announcement in a video released today before a kickoff event in Iowa. Pence joins a crowded GOP roster with more than 10 candidates that is still growing. And Anna, of course, this comes on the back of former governor of New Jersey announcing his candidacy just yesterday. So very quickly moving story when it comes to the GOP.
Yeah, it's becoming a busier field, isn't it? Let's keep our focus on Washington. The UK Prime Minister Rishi Sunak begins his US visit today. He's heading to the capital, to Capitol Hill, in the afternoon. For more on Sunak's first official trip to Washington as Prime Minister, we're joined by Bloomberg's UK correspondent Lizzie Burden, who can give us a rundown of the agenda. What is on the agenda then, Lizzie?
Well, Anna, even though a transatlantic trade deal isn't even on the table anymore, Rishi Sunak is going to want to talk about the economic relationship between the US and the UK. He'll want to put it on the same footing as the security relationship between the two countries, especially when it comes to the Inflation Reduction Act. They're going to want to soften the edges, as the UK Energy Secretary Grant Shapps has put it, because Britain doesn't want to be caught in the middle between the Inflation Reduction Act on the one hand and the EU's response to it on the other. But aside from the economics, they're also probably going to talk about Ukraine, very likely to reaffirm their joint support for President Zelensky. Also talk about China, how they can shore up supply chains and critical infrastructure. And finally, AI, really going to be prominent in this talks, especially after Rishi Sunak has said he wants a global watchdog for AI to be based in London.
Certainly a lot on the agenda for Sunak and Biden. Talk to us a little bit about the chemistry of the two leaders. We know Sunak has had a little bit of a bromance with his European peers. What's his dynamic with the president?
I wouldn't quite use the word bromance for this. There have obviously been moments when Joe Biden has actually forgotten Rishi Sunak's name. And remember, when it was the King's coronation, Joe Biden didn't attend. When he came for the 25th anniversary of the Good Friday Agreement, he actually spent more time in Ireland than in the UK. So the UK press has read a lot into this because, of course, Joe Biden's every move is very choreographed. So Rishi Sunak really is going to be trying to elevate the relationship. It is his first official visit to Washington. I've spoken to the former Prime Minister Tony Blair about the state of the special relationship. He says institutionally it's always going to be strong, but politically needs a bit of work.
Certainly something we're going to be keeping an eye on. A lot to digest between UK and US relations. Lizzie Burden all over that story. We thank you for the updates there. Let's get a quick look at some of the stocks we're watching in the pre-market. I'm going to kind of power through these. Coinbase should be top of your agenda after the SEC has officially filed a lawsuit there. Shares are actually higher by about 2.5%. Kathy Wood overnight saying, look, we still have faith in the company, so perhaps pushing those shares higher. Alongside it, another Kathy Wood favorite, Tesla, of course. TSLA is our ticker, higher by about 1.8%. They're talking about pricing. They're talking about battery makers. And this is really important when it talks about tax credits. Tesla's new cars all now eligible for those. And of course, let's end with Stitch Fix here because their earnings came out, Anna. They are talking about exiting the UK, but they're getting rewarded in the stock market, higher by 7.6% off some cost efficiency plans in the US.
Okay, lots to talk about then when it comes to pre-market. We'll keep our eye on those movers. That is it for early edition. Surveillance is ahead. They'll be joined by eToro's Ben Laidler, BlackRock's Marilyn Watson, and NatWest Markets' Michelle Girard. This is Bloomberg.
York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is an environment where the momentum takes on a life of its own.
It's really been, maybe 5 to 10 names holding up the market, leading this rally.
Maybe the rise in yields isn't impacting people as much as the Fed would have expected.
The challenge with long and variable legs is that they're long and they're variable.
I think the die is cast for the Fed to probably not do anything at the meeting that's upcoming.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The bears are not for turning. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500 slightly softer. You go through all the research over the last couple of days. Mike Wilson, Morgan Stanley, still bearish. Mark Haefele, UBS, still bearish. Dan Iverson at PIMCO yesterday, Tom, saying the bond market appropriately priced for the world that they anticipate. The equity market not discounting the volatility he's looking for.
Yeah, I thought your effort at PIMCO was really, really interesting. Well, some of the highlights of that through the day here, very valuable. What I would suggest, John, is everybody's asleep this morning on the markets. There's a lot going on in the markets, and I'm going to go right to the 210 spread, going out to ever greater inversion, 83 basis points, really buttressed up against maximum inversion, and then you've got the EM angst as well.
Well, let's go straight to China then. Exports out from China, the latest information, the latest data. Lisa, the first drop here for what, 3 months?
Yeah.
Not great, is it?
Especially given the fact that a lot of people are looking for some sort of recovery, and we keep getting information that it's just not happening. What the bleed through here is going to be interesting, and whether China matters as much as it has in the past, given how much decoupling has already happened with this trade data kind of signaling that.
It matters if you're long Europe in a big way, because that trade is starting to crack in a bigger way. Marko Kolanovic of JP Morgan coming out and talking about this divergence between manufacturing and services, and indicating, Tom, that if we get convergence, perhaps we get convergence from services coming down to manufacturing, not manufacturing coming up towards services.
I think that's in the zeitgeist, the idea that we're going to see services in some way slow down and maybe disinflate. That key CPI data is really what we're waiting for. But all of it, to me, and you mentioned the research notes, there's a mid-year reset going on. My favorite note so far, Stuart Kaiser at Citigroup.
Stu's great.
He really was really good about, look, this is the fact. In America, we're willing to pay a stupid premium for growth right now. We'll pay whatever it takes for growth. What's going to change that? I'm not sure I know what's going to change that.
We've mentioned it a few times, American exceptionalism. US exceptionalism back in the equity market. Got to squeeze in some golf as well this morning. Can you imagine Rory McIlroy yesterday waking up to that news? He's turned down hundreds of millions of dollars not to go to live golf, and then bang, the PGA makes an agreement
John,
without your knowledge.
I fell apart with the Oak Hill PGA because that's where I grew up and all the memories of it. In that, I agree with you, the players' heads are spinning, but I think Brendan Quinn in The Athletic was really good.
What did he say?
The PGA is broke. The bottom line is, I mean, what this is really about is they're not Major League Baseball. They're not even the National Hockey League with a huge Canadian deal. Throughout Brendan Quinn's reporting is the reality, the PGA's broke and they didn't have a choice but to affect not a merger, but some form of Saudi investment.
Some kind of joint
into
venture.
American golf.
The tour's up in Canada today for the weekend, the Canadian Open. Sponsored by RBC.
Road trip, I can see that we can do this.
We're going to have some comments, no doubt, through the weekend and through this morning potentially as well. Let's start with the price action on the S&P 500 equity futures. Just a little softer, no real drama here. Just down a touch by 0.1%. Yields higher by a single basis point. The 10-year 367.36, and just about reclaiming 107 on the euro, Lisa. So euro dollar 107 and positive by almost 0.1%.
Yeah, it's been fluctuating between 1.65 and 1.07, 1.065 and 1.07 for quite a while. Right now, we're looking at the 8:30 a.m. U.S. trade balance for April following that China data that you were talking about, which really did show a pretty big disappointment in exports. Do you have a surprise where perhaps the trade deficit in the U.S. isn't as great because of some of these dynamics? How do we sort of look through this?
Thank you for bringing this up. This is not a normal trade data point today.
Because of this dynamic, to understand just how much the decoupling is potentially happening and whether it shows up today. The Bloomberg Invest Conference is happening in New York. Stanley Druckenmiller of Duquesne Family Office, Don Fitzpatrick of Soros, as well as Ray Dalio of Bridgewater and Brian Moynihan of Bank of America. A whole host of great speakers to really set the stage as we enter this half-year point.
It's to set the stage for me talking to Nassim Taleb tomorrow.
It's setting the stage for Tom Keene to talk with Nassim. It's always setting the stage for Tom Keene. Everything pretty much in life is setting the stage for Tom Keene. And today is also the Bank of America Tech Conference. NVIDIA CEO Jensen Huang and Applied Materials CFO Bryce Hill are going to be speaking, which is going to be interesting. It's NVIDIA's world. We're all just living in it. There's also an AI
Bramo, it's not. It's
down in
TK's world.
Washington, D.C.
It's TK's world. We're all living in it.
Evidently.
Making a career of setting the stage.
I take 2 days off and this is what I get.
You brought it on yourself.
Ben Lader joins us now, global market strategist at eToro. Ben, you've heard the gloom. You've heard all the doom on the equity market. It's funny, the bears aren't changing their minds, but even the people who are constructive on the equity market want to leave tech behind and rotate to the cyclicals. Are you pushing back against both those themes?
Yeah, definitely. We're pulling both levers right now. There's only two ways to make money in markets. Either earnings go up or valuations go up. And right now, both are going up. And especially the increase in earnings forecasts is shocking, I think, to the bears. But I think it's just a reflection of this resilience that we're seeing in the economy, that consumers still have, pardon the pun, sort of gas in the tank. So, that's the story so far. I absolutely think that growth is going to slow from here. So I think, tech and defensives will continue to, be the place to be. And I think I wouldn't be, too attracted by the sort of siren calls of derated small caps or cyclicals or commodities. So I think this tech exceptionalism has, further to go, and, it makes a lot of sense to me.
I look, Ben, and let's go off your great call. I believe it was the end of 2018. I can't remember. But you get a leg up, and we've had a leg up here since October, clearly, into a bull market, which you absolutely nailed. What is the second effort now? How do we drive higher after the easy ladler leg up call?
Yeah, so, we're a little bit in no man's land here. I mean, we are looking for the economy to slow a little bit. I think that's inevitable, given the, the 5% rates, what's been going on in the banking sector, spending cuts, et cetera, et cetera. The question is just how big. And I think that will drag inflation down with it, and that will hasten interest rate cuts. I think if you're looking for one catalyst, it's the first Fed cut, which I fully expect to see by the end of the year. I think that is the catalyst for the sort of next bull market, and I think it's going to come with a fairly shallow macro slowdown, which will pull earnings down with it. But I think investors will A, just look over that, and B, I think this is an equity market full of defenses, full of tech, which cares a lot more about inflation and interest rates than it does necessarily about about economic growth.
There's a lot to unpack here, Ben. Are you basically saying that right now equity markets are more defensive than anything else, especially if they're led by big tech, which also you see as defensive and could potentially rally even in the face of a Fed rate cut, which will happen on the heels of economic weakness?
Yeah, the stock market right now is not the economy. You know, it's full of defensives and big tech. It's very long duration. It's not very cyclical. You know, small caps is 15% of US equities. That's the most cyclical bit of US equities. You know, tech and its, you know, hangers on are over 50% of this equity market. You know, I think that's the key distinction. It's not immune, but I think it's very defensive to a slowdown which is coming, and a slowdown which I actually think is going to be, you know, is going to be fairly modest here. I think the recession story is frankly off the table at this point.
One thing I find as a nuance, Ben Laidler, is the belief in the healthcare sector of joining technology for gain. What will be the catalyst for healthcare to do better?
Yeah, so healthcare's been a little bit disappointing, but, you know, I think it shares a lot of these sort of tech characteristics, this sort of defensive growth, these strong balance sheets, these big profit margins, these big moats, and, you know, it hasn't historically had the growth rate that tech has, but it is certainly seeing some sort of pockets of growth. You know, there's a lot of these sort of weight loss drugs, you know, coming to market. That's really turbocharged. You know, Novo, Eli Lilly, you know, Pfizer, and so, you know, I think you can downplay or overlook some of the growth that healthcare really has, and it has a lot of those other sort of defensive sort of growth characteristics that are being rewarded elsewhere in the market on maybe on a less than S&P 500 multiple today. So I think it stacks up as, you know, a decent place to be right now.
Ben, I just want to finish on momentum. We've known each other a long time. You're an incredibly bright, intelligent man. Sometimes when you see moves like this, you need to park your IQ and just sit there and just chase the rally. Ben, how do you actually do that? Can you walk me through just the process there? When you see names up 150, 180%, and people come on programs like this saying things are stretched, then the next week we're up another 15, 20% on those single names, Ben. How do you go about, what kind of process do you have to sit there and say, you know what, we need to park the IQ, don't be too smart about this, and just go with what's working?
I'm not saying you need to chase something that's up 100 or 150%. I do think the biggest risk right now is not being in the market. And, you know, every week I see 10 billion being pulled out of US equity funds week in, week out. So I think this is a massive, massive pain trade. I think you need to be in the market, you know, be diversified, you know, don't, you know, own a basket of stocks, you know, don't chase that sort of one stock wonder. But again, I think the biggest risk has been out of the market, not in. This is a massive pain trade for people. And, you know, again, when sentiment is this bearish, you don't need good news, you just need less bad news. And I think that's been the story all this year.
The whole of 23 so far. Ben, thank you. Ben Laidler there of eToro. City out with this in the last week. It's a great line. Absolutely love it. Lisa, the pain trade with a capital A, a capital I.
Yeah, that's exactly right.
Big time.
Basically, this is all driven on people thinking that big tech was going to fall behind, and it was anything but. And so not only are they out of stocks, they are out of big tech names. And oh yeah, guess what? If they're playing catch up right now, they might be chasing something at the very end of at least the boom, if not, you know, even the rally.
I'd be absolutely terrible at this, Tom. We've talked about it a million times. You overthink yourself into cash. And you sit there and you can't move.
You can't move. Getting back in. The research on this is, good morning, Vanderbilt and UMass Amherst are the best on this. The research is clear as about that's so much harder to go from cash back into a short position or back into a long position as well.
Yeah, although I will say you start to hear things like defensive growth. What does that mean? Defensive growth. I mean, when you start talking about growth, defensives, what does it mean to have risk versus safety if you have basically the entire development of a new industry?
I think AI is way overrated. For example, the Apple Roadshow the other day, virtual reality. Did you get one, John?
I can see you in that headset.
Yeah.
I'm living in my own reality already.
Surveillance. I mean, I don't get it. Full disclosure.
I saw a couple of people make this observation. There were a lot of presentations there, but hardly anyone actually wore the headset.
Exactly.
You noticed that too?
Yeah. What I would notice is they released a new Mac Pro, their state-of-the-art creative computer. Seems reasonably priced, got no headlines at all, and that's where the unit growth's coming from.
I hate it.
Fancy mass things.
I hate it. Some of the reviews.
How
of
do
this
I
thing,
look, folks?
They're going to be able to predict at some point
Surveillance on TV.
what you're actually going to click on, based on the movement in your pupils and.
Do you think
all kind of things.
if they see my eyes coming through, will they see my glasses?
I'm not sure how it works, Tom. That's beautiful. Camera's not picking you up right now, but that looks
For a
great.
reason.
There's a commercial for Apple. Troy Gajewski, Chief Market Strategist at FS Investments in the next hour, live from New York City this morning. Good morning to you all. Equity futures, just a little softer.
Now we got to get a pair of those for Tom Keene. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, it's official. Former Vice President Mike Pence has announced he's challenging his former boss, Donald Trump, for the 2024 Republican presidential nomination. In a video released today before a kickoff event in Iowa, Pence said, quote, different times call for different leadership. Pence joins a crowded GOP roster with more than 10 candidates that is still growing. Ukraine is rushing to evacuate people from flooded areas after that explosion at a major dam in the southern part of the country. The blast flooded villages, inundating thousands of buildings and threatening supplies of drinking water and electricity. Kyiv has blamed Russia. The Kremlin denies responsibility. In Canada, more than 100 wildfires continue to burn out of control. Thousands of people in Quebec have already fled their homes, and more evacuations expected today. The effects are being felt as far away as 500 miles. According to Swiss air quality QAir, New York was the most polluted major city in the world Tuesday night as smoke from the Canadian wildfires blanketed the city in haze. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Multi-trillion-dollar industry. There's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
We have leaders who have shown us over and over again that not only are they devoid of character, but they don't care. You will have no doubt in your mind who I am and what I stand for and whether I deserve it. I intend to seek the Republican nomination for President of the United States in 2024, and I want your support.
We've got another one. That was the former Governor Chris Christie announcing his bid for presidency. The field getting bigger and bigger for the Republicans, with the frontrunner, the president, the former president, Donald Trump, Tom, leading the way. And it's attack after attack coming from the former Governor Christie.
I just looked at 538, just a quick polling here. Christie's not even listed in the polling because he's a new guy on the block. Pence is listed, and of course, this is with his 5:30 release this morning. Here's a partial score. Thank you, George Carlin, for that. Trump, 54%. DeSantis of Florida, 21%. The gentleman from Indiana, 5%. Haley, 5%, didn't have time to get that onto the banner. And others, I don't know where Christie fits into that polling. I guess we'll see from 538 and others.
But that first debate is going to be box office, isn't it? I bring up that first debate because I think a lot can change between now and then, and from that first debate onwards, Tom, through to the election next year.
I think there's a mystery to it. I mean, you know, it's the length of time to get to the election, to get to the primary season is there. But to me, there's a tangible mystery to it, other than the fact right now the former president really demonstrably leads the way, no question about it.
Going to build on some of the coverage around the story in just a moment. If you are just tuning in, welcome to the program. Just to touch base on some of the price action in the equity market.
Yeah, let's do that.
The rally's stalling through this week. I think that's the right way of framing it. Stalling it so far this week in the equity market. Right now, futures just about negative. No real drama here whatsoever. Yields up by a couple of basis points. A 10-year 367.75. Still in and around 370. Disappointing data out of China today. It was all about export data. Those exports falling a little bit more than anticipated. Even with that, the euro doing okay. Just holding on, Tom, there to 107 against the US dollar.
Very quickly, EM, and you mentioned renminbi, 7.12%. And remember when renminbi broke through 7, we were like, OMG, it'll never get to 7.15. We were almost there.
Yeah.
Weaker yuan.
It's been a story.
As well. We'll get the Turkish lira down the road. It's been ugly here for a number of the challenged economies. We need a political brief here. She's hugely popular with all of you. Thank you so much for supporting Wendy Schiller of Brown University, director of the Taubman Center for American Politics. Give me the history here on how people of low polling, either party, can advance towards the primaries. If I see from 538, 54%, DeSantis less than half that, and the others are all single digit, is there any history, Professor Schiller, of single digit-y people doing better?
No substantial history. I mean, you remember the expression, the big mo? And we were talking about George Herbert Walker Bush way back when. And we talked about the big mo. And people perceived other people as more palatable, and he ended up getting the nomination in 1988, for example. So I think that the issue here is the difference for Donald Trump in August, when the first debate comes, is that everybody on the stage will be attacking him in this subtle way, but they are going to use him as the target. That's a new position for him. He wasn't really the front runner when he first announced, and when he first got to the stage, he emerged as a star, but everybody else was trying to make their own case. Now they have to attack him subtly, not to anger his supporters, and make a case for themselves. That's the big problem for the debate for everybody challenging Trump. How do you do that well? There's not enough airtime in a debate with 10 people if that's how many people are going to be on the stage.
Professor, you have a definitive textbook, which, you know, is Great Civics 101 on America. I told you once, Wendy, that you needed to rename the textbook Follow the Money. Is that what this is about? I mean, are all these people running because of a financial advantage in running?
Well, that has become a new cottage industry that, you know, with the advent of social media and a way of making a reputation without the mainstream media, then you have a way of getting speaking gigs, of raising donations. I mean, it just changes everything. But I still think you need the biggest money donors to make it through the primary season. To really launch a challenge to Trump, for example, you need Chris Christie. Where's he going to get the money? There's a couple of people in Jersey that have given a lot of money to the Republican presidential campaigns in the past. Are they going to back Christie? Are they going to back Mike Pence? I mean, with enough really big money, you can run enough ads in some states where Trump may be the nominee, but not super solid, to dent him. But where are those big money donors going to line up? They haven't really announced for Trump, but they aren't really lining up. We saw a little movement towards DeSantis, but then they backed off when he had a pretty disastrous announcement of his campaign. So now where do they go? That will make a difference, exactly as John's saying, between now and August. Those signals are going to be important.
One other signal that's going to be important is whether there's unification among the different Republican candidates on some key issues that affect the money that you're following, such as trade. How much is this sort of a unified view, not only against China, but in general, in a more sort of regionalization of trade, a pullback from sort of the traditional globalization models?
Well, Lisa, this is an amazingly important point because our primaries are still regional, right? And so you still need the big money to worry about regulation and free trade and taxes. And that's pretty constant. That's what they've always worried about. But they also want stability and certainty. They don't want chaos. They don't want unpredictability. And it's funny because, not funny, but Trump, presents pretty chaotic future. We don't know what he's ever going to do in any given moment. But now DeSantis has proven to be someone who may not be predictable, who may kind of want to jump the shark in terms of regulating business with his feud with Disney. Is he really a reliable investment? And that's what I think businesses are looking for. It's traditional Republican platform, but it's also coupled with certainty and competence in terms of smooth government running. We saw McCarthy sent that signal clearly to Wall Street. I will make sure the trains run on time and I won't crash the economy. That's a very clear signal.
One big question I keep hearing from analysts on Wall Street is if the rhetoric on both sides of the aisle is rewarded if it's inflammatory toward China in particular, saying that we want to isolate them, we are in a huge rivalry with them. How are we going to soften the tensions even as Tony Blinken heads over to Beijing?
Well, I think the question is how much knowledge or how much credibility do these Republican candidates for president have on foreign policy? Trump made China the enemy, right? Very large tariffs, and then with COVID, blaming China. How's he going to walk that back? He's not going to be able to do that. And Ron DeSantis, just had a big Asia trip, trying to sell himself as somebody who can negotiate the world stage. Mike Pence has a pretty calm demeanor. What's he going to do? How's he going to sell himself this way? And the rest of the candidates don't really have, well, except for Nikki Haley, have a lot of foreign policy experience. So who's got the credibility in the Republican primary on China? And China doesn't even know. Who do you really look to and say this person could get elected and we can do business with them? That's where Biden has been somewhat measured with China, as you just point out. Secretary of State is sort of attacking China, but not attacking China. And that's going to be somewhat calming as a signal, I think, to the business community.
Wendy, there's one name that we haven't mentioned, Governor Youngkin. Wendy, there's this feeling at the moment from people I speak to that the worse that Governor DeSantis does, or rather the fact that he's not improving, the more Governor Youngkin thinks about making a run. How are you thinking about that one?
I just don't know that he has, the ability to jump to the national stage with any force or energy. He's got a good platform. He won an election against somebody who was well-known and not always well-liked, Terry McAuliffe, in Virginia, so he got kind of lucky with his opposition. And Virginia is still a swing state. It's swung more to the right recently, but it's still a swing state. Do you really nominate for your nominee somebody who cannot absolutely deliver their own state? DeSantis will deliver Florida, but we saw Al Gore did not deliver Tennessee. These are things strategic people worry about, money people worry about. Can he sell himself really to money people to make a big enough launch?
Interesting. Wendy, just wonderful to get your perspective. Wendy Schiller there of Brown University. China a feature of that conversation. Usually with pollution, it's blame China, TK. A little bit different over the last 24 hours here in New York City. It's blame Canada. Blame Canada and the wildfires.
Well, I don't blame Canada, but yes, it is about many.
It's a bit of a joke there, TK. Yeah. Not literally, but
many wildfires in Canada. Let's get some perspective here. This is from Air Matters. I actually use this app when I'm in China. And John, Manhattan is worse than Delhi right now. It's a little bit dated off of last night. Manhattan 154, Delhi 151. Shanghai always polluted 80. New York City expanding from like a 50 or 45 level as well. Washington D.C. is actually a little bit worse than New York City right now, but the forecast here is good. The forecast in Delhi is not good.
You could really feel it yesterday, landing in JFK, coming down through the smog, this red kind of tint to it, this orange tint, Bramo. You can feel it.
Oh, yeah.
You can feel it for sure.
It would have been a good day. It would have been a sunny day. It would have been a clear day, and it felt like the rain clouds were coming in, but it wasn't rain.
It's like Bramo on the equity market.
It was a toxic brew.
Something like
it
that.
literally was a toxic brew.
It's better this morning.
Alberto Gallo in the studio on Credit. Up next.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
Connection lost. Verbatim commercial break. Give me some love. You feel unloved this morning?
I feel unloved. I'm surrounded by Naples and AC Milan. What do you think, Lisa? It feels like an Italian love fest here.
Yeah, it seems like I think you have to do some YouTube clip hunting right now.
Yeah.
You feeling neglected?
I had 2 days off, and it was hell. You know,
we'll get some people to give you some
My
love.
vacation is this job. It's not like a real job.
Oh, this is the vacation.
I feel like I'm on the PGA.
I'd love to know what you feel like on actual vacation if this is the vacation.
I haven't taken a vacation in a long time. I don't do vacations.
Okay. Here's your equity market on the S&P 500. I'll try and make this a little bit more cheery for you. Equity futures just slightly positive. We turned positive in the last 10 minutes or so. Nasdaq going nowhere. Nasdaq has been going somewhere, though. Wow. Since early May, when the Fed last met, this equity market, the Nasdaq 100, is up by around about 12%. Now think about that. You've had a 12% move even with this in the bond market. So pull up the 2-year. Take a look at the 2-year. So when the Fed last met, May 3rd, at the end of the day, we were at 380. We've added 70 basis points to the front end of the yield curve, and still, this equity market is doing quite nicely.
John, everybody's writing their mid-year reviews. I mean, we're on there. They're starting to creep out. Ellen Zentner, I know, did one a couple days ago for Morgan Stanley. Here's the mid-year review. Dow up 1%, SPX up 12%, NASDAQ Composite up 27%. There's your mid-year review. Where was everybody? It was a lonely crowd, 12/31/22, saying get on board.
We're back to these secular growth stories where the economy doesn't seem to matter, valuations don't matter, because it's going to be bigger than the dawn of the internet. Bramo, AI. And I go back to that phrase from Citi, the pain trade. Ben Lader, eToro called it a pain trade. Many other people are too. The pain trade with a capital A and a capital I.
Is the pain trade real? Is the pain trade just people getting stopped out of their bearish positions, or is this something that has legs? And that, I think, is one of the big debates underpinning the mid-year calls.
And the study here, the zero hedge summaries every afternoon are great on this. The study here is what is the level of gloom out there? And the answer, I believe, Lisa, correct me if I'm wrong, is it's pretty gloomy. I mean, there's a lot of people betting against this move.
But how much do you see, and John, I'd ask you this, how much do you see people saying they're gloomy and they're saying the economy is going to roll over, but then you ask them about their positioning and they're like, well, you find defensive growth. Okay, well, what does defensive growth mean? Or they find, stocks that have good, solid income, which is big tech. I mean, at what point is this really bearishness?
And when it goes to credit, what do we hear? We want to go up in quality. Up in quality is what you hear from every single cross-asset strategist on this program.
We're going to go up in quality right now, and what it's about is asking about the markets. We had this with John Farrell's leadership yesterday, a modest effort out at PIMCO with some very, very smart voices. We're going to dovetail it into a conversation with Alberto Gallo of Andromeda Capital Management. John, I want you to bring in Alberto here, and I want you to bring him in off the detailed discussion on and off camera yesterday at PIMCO about what the moderate end and the long end is going to do. And you mentioned on the break the term premium. Bring that into the shock that we could see price down and higher long-term yields.
Well, I think you have to start with the inflation target of the Federal Reserve, which is 2%, and you have to make a call on what they're going to tolerate. PIMCO believes they'll tolerate 2-point-something.
Clarida has been very visible on it.
The former Fed Vice Chair. And ultimately, they're going to carry on forecasting a return to 2, whilst accepting and tolerating 2-point-something. So something maybe even approaching 3. And with that in mind, there is a call on the long end that you start to price in and rebuild this so-called term premium around the inflation story, and you end up with a steeper curve. So that's the long end yields shifting higher. This is the call right now, Alberto, from the likes of PIMCO, and I think that you're thinking about a similar thing.
So look, we had 500 basis points of hikes, and the job market is still pretty solid. So there's something central bankers are not doing, and that's the long end of curves. If you think about a large company in the US, you can fund at 3.6% roughly plus a spread, and then you can invest in T-bills. That's a carry trade. Same for homeowners. 98% of homeowners, according to Goldman Sachs research, has a mortgage that was issued at lower rates. So if you just hike the short end, even to 6%, that's not really tightening. You're doing half of your job as the Federal Reserve. So what you really need to do is to make sure that the long end funding cost also goes up. That's how you tighten financial conditions. And so far, that hasn't happened. So it's really, you know, if central bankers are serious about what they're doing, there needs to be some steepening in the 5-year and the 10-year point of the curve, and that's really what's going to hurt financial conditions. That's going to tighten asset prices, but that hasn't happened yet.
So let's make the policy call.